Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures pulling back today after the S&P 500 closed at a record high on Thursday's trading session. Meanwhile, global stocks are looking to end the week in the green after President Trump appeared to soften his approach towards tariffs on China. In an interview that aired Thursday, the president said he would prefer not to impose tariffs on China, citing tariffs as a, quote, tremendous power over the country.
Plus, Bitcoin pushing higher this morning after President Trump signed executive actions relating to cryptocurrencies and artificial intelligence. The crypto order creating a working group to advise the White House on digital asset policies. They're going to submit a report to the president within 6 months. Meanwhile, Trump was also joined at the White House by AI and crypto czar David Sachs, who said that the artificial intelligence action would allow the U.S. to dominate, quote, and lead the world in AI.
And Boeing shares are sliding this morning after announcing another quarter of charges and losses. While much of the attention has been on troubled civil aviation unit within the company, the figures revealed the state of the defense business, which suffered $1.7 billion in charges. The stock still lost about a third of its value last year, the worst return since the height of the pandemic. Futures are edging lower after the S&P 500 notched its first record close of the year Thursday afternoon. We're also seeing gold near record highs as the dollar is weakening, reacting to a seemingly less aggressive tariff stance from President Donald Trump, saying on Fox News Thursday night that tariffs are the one very big power that the U.S. has over China, and he would, quote, rather not have to use them here. We certainly have been watching markets try to get the he loves them not around tariffs, but we do know from previous administration, we do have that history to look back on exactly what type of targeting could come forward in the tariffs, what the negotiating power within that would look like, and then, additionally, what type of impact that would have for some of the U.S. companies that have the largest or outsized revenue exposure to China specifically, as we think about some of the tariffs that were enacted in the tit-for-tat trade war that did play out back then. And now much of the conversation around, okay, what other areas would be targeted here, and investors best trying to run the calculus around that.
Yeah, and we have certainly seen some of the smart money, and I mean, take a look at some of the top economists on the street just reassessing the risk here of these tariffs and what ultimately that is now maybe more realistically going to look like. Goldman Sachs was out with the note earlier this week saying that they now see only a 25% chance of a universal tariff this year. Now that was versus 40% previously, so a dramatic decline just in terms of that probability there from that team. They're also saying that they see a 70% odds of a roughly 20 percentage point tariff hike on imports from China versus 90% previously. So again, we are starting to see some of the top economists on the street right now, forecasters scaling back their expectations of tariffs. And that has very much been reflected in the markets this week. Yes, we are getting a bit of a breather here this morning. We're not seeing too much movement ahead of the open for all three of the major averages. But I think overall, the markets have very much sighed a collective breath of relief here this week, just in terms of the fact that we did not see tariffs enacted on a day one of the Trump administration. That was one of the things that had been feared just a bit, just in terms of some of the uncertainty that is going to then further introduce into the market. But I think the road ahead still very much remains unclear. And we've talked to so many strategists here this week, so many economists who are saying that there's still much on the table. There's very much unknown on the table, and that is making the next several months a little tough to game out at this point.
Well, and think back to just what we heard yesterday from President Trump as he was video addressing the people who were in Davos, world leaders, elected officials, some of the corporate leaders as well, big banks that were represented and being able to ask questions, chiefly Brian Moynihan, as we were hearing in from exactly where the inclination is for these entities to also understand what type of tariffs may come forward here. And he ultimately was giving a sense that, hey, if you manufacture in the U.S. or if you bring more of that manufacturing power into the U.S. or make investments, then you'll be able to skirt some of the tariffs. But to the extent that we'll still see some of those tariffs come forward in other elements, and I mean, we're or not even a full week into his presidency. So there's still a lot of time in order to really understand his assessment of where he would like to inflict not just economic power, but also try and get something back for what he would be implementing in the form of tariffs.
Yeah, we'll see whether or not the February 1st deadlines that have been now announced are likely here, whether or not that actually goes into effect just over a week from now. All right, well, Bitcoin moving higher after President Donald Trump signed an executive order intended to support the growth of the crypto industry. The order calling for the Treasury Department to create a working group that will provide a regulatory framework for the industry. The order, though, was met with a bit of a mixed reaction there from those within the crypto community. Some expressing some disappointment that it didn't specify and include Bitcoin as the center of a national reserve. Joining us now for more, we want to bring in Samir Karbaj. He is the Chief Investment Officer at Hashdex. That's a crypto asset management firm. Samir, it's great to have you here on the show. Let's talk about maybe some of that disappointment that we certainly are seeing play out within the crypto industry. I'm curious just to get your take and maybe the lack of details that we got yesterday.
Hi, Sean and Brad. It's great to be here. So it's been a great week for crypto, actually, on the regulatory front. We saw Tuesday, the SEC has created a task force basically to provide guidance to the crypto industry. That release, creating the task force from Commissioner Ueda, was had a very clear stance that the end of the era of regulation by enforcement was clear, and now we're going to see a new era on the SEC. We saw the SEC rescinding the SAB 121 that basically blocked banks from offering crypto services. And yesterday we saw this executive order creating this working group in the executive branch to look at crypto regulation, look at the stockpile. I think people were waiting probably to create that this strategic reserve of Bitcoin will be created from day one, but we know how those things take time, right? We need to look at those policies with care. And now this working group will have 180 days to design policies for the crypto industry. This is huge.
What is the timeline that the crypto industry and investors or some of the largest execs that certainly do have their own larger skin in the game here, what's the timeline that they should be grading the administration on putting forward some of not just the working group elements, but also the conclusions from that working group and actions?
So what this executive order basically defines is that this group will have up to 180 days to propose policies, propose legislations, and propose actions from the executive branch. Some of those actions might be implemented by executive order, so don't need to go through Congress, and that can be a big advancement to the industry. But I think the big ones will depend on congressional approval. So especially giving clarity on stablecoin and stablecoin adoption, this can be huge. So it's important to know that stablecoin has been seeing a major adoption in emerging markets and not much in the US because of the lack of regulatory clarity. And this is one of the killer apps for blockchain technology. So given that clarity might have to go for Congress, the clarity around which assets are securities or commodities and how to regulate assets that are named as security, this also might go for Congress. So I think this is going to be more like a medium to long-term thing, but we're up to a great start.
How would you like to see the strategic Bitcoin reserve be built out? You know, as we're thinking about the amount of crypto that the U.S. already holds because of a combination of seizures as well, 200,000, which is over 200,000, and it's still more than any other nation in the world here. So building upon that, how would you like to see that enacted?
So the U.S. government is one of the largest holders of Bitcoin, okay? And I think that Trump was very clear in naming stockpile, not reserve. And I think that what he can do with an executive order is basically stop selling those assets that the U.S. government has accumulated. So not selling the assets, the other administration was preparing to sell, was actually selling some part of those assets in this stockpile, and maybe with an executive order, he can block that selling and start to accumulate from new seizures. And the other thing that will depend on congressional approval is establish a national reserve. So start actually buying crypto, buying Bitcoin, selling part of the gold reserves and buying Bitcoin reserve. That depends on a legislation. Senator Cynthia Lummis introduced that, and let's see how that's going to be handled by Congress.
Samir, thanks so much for taking the time here with us today. We know you'll be watching this very closely, as we will be too.
Thank you, Brad.
Thank you. President Trump, excuse me, it takes a little bit for habits to change. President Trump promised huge tax cuts during a speech to the World Economic Forum leaders on Thursday. Take a listen.
To further unleash our economy, our majorities in the House and Senate, which we also took along with the presidency, are going to pass the largest tax cut in American history, including massive tax cuts for workers and family, and big tax cuts for domestic producers and manufacturers.
Worth noting, President Trump's proposed tax cuts are actually the 6th largest in U.S. history, according to the nonprofit Tax Foundation. Here with more on how these tax cuts will play out and what will be needed for them, we're joined by Brendan Duke, who is the Senior Director of Economic Policy at the Center for American Progress, and former Representative Kevin Brady, who previously served as the chair of the House Ways and Means Committee and was the main architect of the 2017 Tax Cuts and Jobs Act. Great to have you both here with us this morning. Former Representative, I want to start with you. As you think about what is going to be necessary to get a Tax Cuts and Jobs Act, TCJA 2.0, over the line, what are the critical keys to bringing that together?
You know, I think clearly the Trump tax cuts worked from the standpoint of economic growth, bringing investment back to the United States, and record wage growth, especially in those first 3 years pre-COVID. I think the key here is to lock in really the growth in that tax code going forward, making permanent some of the key business provisions that have begun to lapse. That's very key. But I think for Congress, you know, finding a path forward on extending or making permanent the middle class tax cuts, certainly the child tax credit issues, and the small business pass-through tax cuts, all very important. Right now, they're taking the first step, which is working with the president to identify his priorities in TCJA 2.0, as well as identifying a bill, a reconciliation, a budget bill that would allow them to pass tax reform later this year. They've set a pretty aggressive timetable for doing that, but they're in those conversations now among themselves and with the president to really identify the framework to move forward.
So, Congressman, even with the very narrow majority right now within Congress, you think they will be able to gain that necessary support?
You know, I think they will. It won't be easy. Reconciliation, that budget process is hard in the best of times with a major majority, with the near zero majority. The degree of difficulty is higher. I think that's why they began like day one after the election, having these internal conversations, and having been in them myself during 2017, you know, you got to find out what the priorities for Congress and those individual members are. Weigh those priorities and work with the president to find that framework. Again, you know, such a small majority, you know, makes it difficult, which is why I think they're spending an incredible amount of time trying to find that common ground.
Brendan, I want to bring you into this conversation. There are proponents that would say that the trickle down that's anticipated from the Tax Cuts and Jobs Act 1.0 didn't necessarily occur because there was a wider dispersion or a wider gap now between some of the wealthiest versus some of those who were anticipating for tax cuts to positively impact them, but didn't also have the same ability to use some of those savings from tax cuts to invest in the stock market, to have other forms of wealth management and wealth building as well. Just want to get your reaction and your anticipation to what 2.0 will do to narrowing that gap.
Sure. I think the key thing is tax cuts are not free. They are going to drive up interest rates. If we put them on the nation's credit card, it means we are going to cut Medicaid or other healthcare programs to pay for them, or tax every imported good coming into the country. So I think that's a critical part of it. And when the Congressional Budget Office did an analysis of extending those tax cuts, they actually found it would reduce growth in the long run because of those higher interest rates, as Americans are paying more for our mortgage, as housing investment goes down, driving up housing costs, et cetera. So I think the key thing is that these are tax cuts very tilted to wealthy people. The average tax cut for the top 1% is $60,000. Below and middle income families are going to end up paying for it when it comes to the grocery store, when it comes to their credit card bill, or when it comes to, you know, going to the doctor's office.
Congressman, what's your response?
Well, most economists use percentages as the fairest measurement, and from that standpoint, certainly TCJ was weighted to the lower and middle income taxpayers. Actually, the burden of overall taxes increased by almost a quarter for the higher wage earners, reduced by almost the same amount for the lower and modest wage earners, and real wage growth, which is really what we were shooting for. We wanted higher paychecks, higher growth, more jobs. But in the first 2 years after TCJ, real wages grew by over $6,000 on average. That was more than the past 10 years combined. In the first 3 years were record wage growth. Extending these tax cuts, making sure we continue that growth, try and get now ahead of the inflation President Biden created, I think is going to be a big goal. I think they'll certainly continue to see a stronger economy. That's what voters certainly were at the top of their minds when they reelect President Trump.
Well, Congressman, real quick, and then Brendan, we'll go back to you and get your thoughts here. But then what is the right way to balance or the best way to offset some of the costs that are associated with extending the tax cuts?
Yeah, so as you may remember, the tax cuts in 2017, about $4 trillion of it was paid for with the president signing the bill. We built in that in the tax reform. We saw record growth, especially among corporations, revenue to the federal government afterwards. Congress is looking to replicate that type of growth and that revenue growth. But clearly, as you've been reading, they're looking at ways to address the deficits and the costs of this, whether it's through energy. I know the president loves tariffs and the revenue that it generates, but they're also looking at a government that grew dramatically after COVID by $2 trillion each year. So they're looking at ways to really carve that back, sort of rebalance the size of government to where it was before those COVID spending years. And they're serious about trying to address the deficit numbers going forward.
Brendan, with the time that we have left, earlier this week we spoke with Mohammed El-Arian, president of Queens College, Cambridge, about the economic dispersion in the United States, the idea that the economy is doing well, but it's not being felt equally. I want to play this clip and get your reaction on the other side.
The issue of dispersion, or what a lot of people call the K-shaped economy, where the rich are doing better, but the poor continue to struggle, that was very well understood by President Trump. And that is the reason why the electorate didn't appreciate the economic exceptionalism that everybody talks about, that is strong US growth, because the benefits of that growth were not shared widely.
So would an extension of the 2017 tax cuts and cuts to social welfare programs, in addition, at the same time, because we have the compounding and conflicting of whether or not we might see tariffs get rolled out as well, would that worsen the divide?
Yes, absolutely. So those tax cuts are larger for people at the top of the income distribution, to CEOs and high earners, than to people working at McDonald's, people working as janitors, as a percentage of income, right? And then on top of that, again, it matters how we pay for it. It is telling that Congressman Brady would not say how he would want to reduce that deficit impact. The tariffs, for example, would tax every time an American goes to buy sneakers, to buy bananas, anything like that. It's the most regressive tax we have on the books. President Trump seems like he wants to double down on that and really just pay for tax cuts for wealthy people by making it more expensive for working and middle class families to go to the grocery store. I don't think that's why he won the election.
Congressman Brady, we only have 15 seconds. Your response?
I think it's important to watch this play out. Certainly, I think you're seeing pretty healthy discussion on how the president uses tariffs, whether for leverage to address unfair trade practices or in broader mechanisms. They're having those conversations today. I think it's right to be strategic. I'm not a tariff advocate for any president, but I think it's right to have that thoughtful, healthy debate before the president makes those moves as he's doing.
Kevin, Brendan, thanks so much for taking the time here with us today. We appreciate it.
Good to see you.
We'll continue to monitor as well. Guys, coming up on Morning Brief, we'll count you down to the opening bell on Wall Street. Plus, we dig into Boeing's surprise announcement ahead of its earnings next week. Plus, Novo Nordisk shares spiking off the back of strong results from its experimental weight loss drug. We got the details next. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to take a look at Boeing. BA is the ticker symbol there, estimating $3.5 billion of operating cash flow losses in the fourth quarter, citing labor strikes and layoffs. Now, Boeing's preliminary earnings coming in below Wall Street's expectations for earnings and revenue. There you're taking a look at shares. They're only fractionally lower right now by about 0.8%. Of course, it's been in a battle period for Boeing over the course of the now, at this point, 12-month period that has included everything from trying to have a successful leadership transition, but then additionally, of course, the fuselage blowout of an Alaskan Airlines flight, and then everything in between, especially with regard to one of their key, at least, growth areas in the 737 MAX, and trying to make sure the production reinitiates in full swing there.
Yeah, exactly. And I think this just very much lays out the challenging road ahead, at least over the next several months for Kelly Ortberg, as he does try to right the ship at Boeing. There has been some progress made. We've talked to many analysts who are still bullish and positive on the stock and like what they have seen from Ortberg and some of his initiatives here so far, just in terms of cost cutting, in terms of slimming up their operations just a bit and really refocusing on the core of their business. But in terms of going forward, obviously that cash burn rate, that is something that is going to be top of mind here for investors, for the street, but then also just the impact of the strike and maybe a more long-lasting impact than what we had initially anticipated. And I think that was very much reflected in these numbers that we got out late last night when you take a look at just how long it took for the production facility to get back online. Now, you have to remember that the strike ended in November. It wasn't until mid-December, I believe, that there was production resumed at the plant. So again, when you talk about the lasting impact of that, what that's going to do to deliveries, not only in the current quarter right now, but looking ahead over the next several quarters, also something that's top of mind for many of the airline executives that we've been hearing from as well.
Yeah, they said within this preliminary fourth quarter results release, they restarted 737, 767, and then the 777 and 777X production. Their team are trying to remain focused on the hard work ahead to build a new future for Boeing and a lot of their customers, especially on the airline side, who we've spoken with as well, whether that be Delta CEO Ed Bastian, who, of course, they don't have any of the MAX 10 coming into their fleet. At this point, the anticipation is not till 2026 for that, but more pressing, perhaps a little bit more for Bob Jordan and team at Southwest Airlines here.
All right, let's take a look at one mover here to the upside pretty significantly. You're looking at 11% climb here for Novo Nordisk. Shares rising double digits in the pre-market action after releasing positive early trial results for its weekly obesity injection drug. Yahoo Finance's senior health reporter Anjali Kamlani joining us now with the details. And Anj, clearly lots of excitement playing on the street, but what can you tell us about this?
Yeah, so first of all, that pop also contracting just a little bit, and I'll tell you why in a second, but taking a look at the numbers, Novo Nordisk out with their new product, or the test of their new product, early phase trials showing 22% weight loss after 36 weeks. And this is a new kind, or their sort of next generation, if you will, of product, and that is the amycretin injectable. That is a weekly injectable, kind of like what they currently have with Ozempic and Wegovy. It's important to note that they already did have results late last year on their pill version of this same drug. That had a little bit unfavorable results, and that is why you're seeing a little bit of that contraction on the pop, because the side effects are still questionable. The pill did have some questionable negative side effects, and so they're waiting to see what that actually looks like for the injectable as well. Novo Nordisk did not include that information in the press release, stating just that it had similar, quote unquote, gastrointestinal issues as other GLP-1. So that could be anything from nausea to vomiting to, a bunch of others. So that's what we're keeping an eye on right now when it comes to this. This does give Novo a leg up, though, because it now puts it on par and a little bit above with Lilly's tirzepatide. So that is why you see Lilly stock down just a little bit, not enough to knock it off, because this is still early stage results. And so we're waiting to see what the later phase will show. Novo Nordisk saying they're going to move ahead with this product in the pipeline and see how it pans out in phase 3. But this does give, analysts are saying that this does give Novo now a little bit of a boost, considering that it had disappointing CagriSema results and then has sort of fallen back a little bit with supply compared to Lilly. So this could give it a little bit of a boost in the near future.
All right. So as we're continuing to watch all of this, of course, Novo shares right now jumping on this. It's really a question of what type of other innovation we're expecting to see from some of the weight loss drug makers that the market will receive. Now, what price point, too?
Price point. Also, do we need more, right? The question has been, when the CagriSema results came out, it was like, okay, well, it was actually similar results. They did have 22% weight loss, but the question was, it's a semaglutide product partly, and so do we need something like that in the market? Does the market need more of the same? Do we need more 20% weight loss, 24% weight loss, or is the market saturated there? And what happens to all the other little guys following along behind, the biotechs that have similar results as well or are working on similar products? So it looks like it's going to be interesting to see how the market plays out, whether or not the demand stays there. We've seen, of course, the unprecedented demand. Supply has not caught up yet, and so we'll have to see if that continues or if it stabilizes, plateaus, and we're just done with it.
All right, Anj, thanks so much for breaking that down. Keep it right here on Yahoo Finance. We've got much more coming up ahead on Morning Brief. We've got your opening bell when we come back. And that's the opening bell here as we kick off the final trading day of the week. Also wrapping up President Trump's first week here as president. The markets digest some of the policy proposals that we have heard over the last 4 days. Taking a look at the major averages, a bit of a give back here this morning, but not too much movement here. You have the Dow just below the flat line, off about 0.1%. Flipping over to the S&P, you're actually looking at slight gains here, just above the flat line, and then the Nasdaq up here as we do calibrate the open here, up just about 0.2%. Taking a look at the Russell 2000, some of the smaller cap plays certainly has been top of mind here for investors here heading into 2025, and obviously during the first several trading weeks here of 2025. We're taking a look at gains of just about 0.5%. Lots of talk about the bond market's reaction and the fact that we've been relatively range bound here this week. I think a bit of a surprise here for some, given the massive climb and the volatility that we have seen play out in the bond market here leading up to President Trump's inauguration. But you're looking at a move here with the 10-year yield right around 4.65. Flipping over to the sector action, what we are seeing here on an intraday basis, you got materials, communication services leading, healthcare, real estate lagging. But if you take a look at that 5-day chart, giving you a better picture of what we have seen, actually 4 days since the market was closed on Monday. But you've got technology leading the way, industrials not too far behind. Flipping on the other side of the, you have utilities just in the red, and energy, the worst performer so far this week. Jared Blickery standing by with a closer look. Some of this movement that we're seeing, Jared.
Thank you, Shauna. I want to go back to the S&P 500, just coming off of that first record high of the year, and I'll show you a 3-month chart here. That's 10-year T-note yield. So we'll go over to the S&P 500, and there we go. Broke those highs yesterday, finally into the close after flagging. We do see the Dow snapping a 4-day win streak right now, but it's a few hours to the close, and we'll see what happens. Nasdaq, S&P 500, large largely just treading water right now. So kind of a quiet Friday to start off. Here's the US dollar index that is down overnight. This is a 3-month chart, and you can see we have now fallen to a 1-month low basically. So that is good news for risk assets. And we want to go to the sector action where we see materials and energy leading, not by a large amount. Healthcare is taking the downside by about 23 basis points. I want to point out though, here's a 1-year chart. We are just now breaking through this negative trend line, and so that is a nice breakout that's getting some attention from technical traders, and we'll have to see if anything comes of it. Maybe not today. Want to go to the Nasdaq 100 where we have Meta and Amazon coming off of record highs. Just got a CapEx announcement from the company that says it's going to be a little bit higher than Wall Street expected. More spending now maybe means more profits down the line. In the wacky world of finance, that's what's being priced in right now. That stock is up 0.5%. And we got to go to the futures market because we see some interesting things there. Crude oil, first of all, crude oil, and this is platinum. Let's go to crude oil. That is snapping a 4-day losing streak, so it's trading to the upside. This is a 1-year chart, and you can see it has recently broken out of that negative trend line. And then gold. Finally, gold is just about at its record high. That is Brent. This is like playing whack-a-mole here, but we'll see if I can get GC equals F. And there we go, approaching $2,800, actually $2,801 an ounce. That would be the record. Sending it back to you, Brad.
Jared, I have no doubt that you had a famed history in the days of Chuck E. Cheese playing whack-a-mole.
Yes.
Quite good at it.
You bet.
Thanks so much, man. Appreciate it. Time now for today's strategy session. Trump tariffs, a lingering concern for the global investors, but our next guest says focus on equity fundamentals as a buffer to those risks. Joining us now is Young-Yu Ma, who is the BMO Wealth Management U.S. Chief Investment Officer. Great to see you here in studio with us, and thanks for taking the time just after the opening bell. As you think about the characteristics that should really framework the investor's mindset around fundamentals right now, what are some of the pillars to that?
Yeah, thanks, Brad. It's great to be here. I think if we look at those pillars, and it's important to take a step back because there could be disruptions related to tariffs this year and other policies. But the importance of fundamentals is to give us an understanding of what the buffer is, how much the economy and the markets can sort of absorb and disruptions that can be managed and worked through. And we see that both the consumer and corporations right here as being in a very healthy spot. Spending has been healthy. Neither consumers nor corporations are highly levered. And oftentimes when you get to a point which is considered maybe mid or later cycle, leverage starts to build. We don't have that now. So there's a good buffer. But you add on top of that these AI trends, the spending trends like Jared was talking about, additional CapEx by these hyperscalers, and productivity gains that we think are going to start to kick in this year. We think the backdrop is pretty positive, and those fundamentals can withstand a lot of bumps along the way this year.
When you take a look at the fact that the market's off to the best start that we've seen under a new president since 1985, since Reagan, I guess will very much some of the sentiment be put to the test next week when you take a look at big tech earnings and how much is riding on the handful of those results?
Well, a lot is riding on them in aggregate because they have such a large weighting in the index. You know, if we're thinking about the whole year, though, I think what's more important is to see what's the data and what are the anecdotes that come out of the typical companies, the average companies in the S&P 500 and the Russell 2000, and how are they implementing AI? How are they getting benefits from some of this? So, you know, these mega-cap companies are such a large weighting, you can't not focus on them. But I do think that the story this year is really going to be more about how these trends are permeating throughout the typical company.
And what do you expect to see on that front?
I think we're going to see a lot of news about how companies are using and implementing new technologies and AI to really enhance productivity, to be able to grow without adding much to their costs and their bottom lines, to find ways to improve the efficiency of their workforce, and that helps margins, that helps profit growth, that even allows for greater wage gains. Productivity is really a type of a silver bullet. You can have your cake and eat it too, in terms of getting this growth, but also getting health, stability, and wage gains for employees.
It's two-pronged, right? Because there is the, of course, investor mindset that says, all right, how much of that is already baked into the shareholder value and the returns that I've seen there because you've seen the wave of investments from companies who are beneficiaries of B2B spending. But then also it's an economic issue too on the front of, okay, well, that productivity also means that there might be less need for labor force participation, or at least the same scale of employees that we had in previous cycles of labor force participation. How do you kind of balance that?
Yeah, that's right. That's a good point because as we get more productivity, the need for, if we can get that growth, but that growth might not need as many new workers in certain areas, or there might be shifts, right? You need workers in some areas more than you did in other areas. The good news is we're approaching that stage, or approaching this sort of disruptive period at a very low level of unemployment. So we're not at a point where the labor market is fragile or is prone to cracking, or the consumer spending is sort of starting to wobble here. So we're approaching it from a very stable standpoint. We are going to get disruptions. That's what new technologies do. So I think that's part and parcel with what the economy has to work through, but fortunately we're in a good spot to handle that.
Are there sectors that would be most likely to experience those disruptions earlier on and kind of, lead out in front of some of those disruptions?
Well, I think the financial sector has been talked about a lot, but there are a lot of industries. The legal industry is starting to implement AI a lot as well. The healthcare industry in terms of drug development. There's a lot, middle management in general. There are a lot of areas where new technologies companies are looking for new technologies to help that middle management layer be more efficient, perhaps not need as many workers in that space. So, I do think it's very broad-based, but certain sectors are more on the forefront for sure.
All right, Young Yu, thanks so much for taking the time to join us here in the studio.
Thank you.
It's time now for our chart of the day, with stocks trading near record highs. Corporate insiders are rushing to sell shares of some of their companies. Let's send it over to Catalyst co-host Madison Mills for a look at some of the action that we're seeing. Maddie.
That's right, Shauna. Corporate executives selling shares of their own companies at a record rate. You can see here corporate insiders dumping shares of their companies. And in this particular case on this chart, that's going to appear like it's at a record low. But in terms of the amount of selling that we're seeing, the buy-sell ratio here is indicating corporate insiders selling those shares of their own companies. So that's obviously a bearish signal, right? You don't want a corporate executive selling their own firm. But at the same time, we're seeing corporate buybacks continuing to hit record highs. That potentially is a bullish signal, but it could also mean that executives see signs of a macro challenge ahead, and so they want to shore up their own company's shares while they themselves get to have a little bit of profit taking, and perhaps that's why we're seeing a little bit of that insider selling. It's not too unusual when you've got a market with this much growth that we have seen. Having said that, insider selling of shares, typically a really strong early signal of bearishness. This has been a signal that has indicated a market bottom in 2015. 2018 and 2020. And lastly, I'll mention it coincides with retail investors buying $7.8 billion worth of U.S. stocks over the last week, the most since November of 2023. And sometimes the smart money says when retail comes in, it's time to get out, guys.
All right, Maddie, thanks so much. Appreciate it. Taking a look at one stock moving at the opening bell, we've got American Express. American Express is out with Q4 earnings this morning, reporting record revenue for 2024. Profit climbed 12% in the fourth quarter, driven by holiday spending. For 2025, American Express anticipates sales growth between 8 to 10%. You're seeing shares of the company right now moving lower by about 2%. We do have a comment from a good friend of the show and frequenter on Yahoo Finance as well in the past, Stephen Squarey, who is the chairman and CEO, and he says that 2024 was another strong year for American Express. Record revenues, $65.9 billion. It's up 10% FX adjusted. And then additionally here, earnings per share, $14.01 full year encompassed here. That's up 25% year over year.
Yeah, so you might be asking yourself, I guess, why the stock is down today, right? When you're looking at shares at just about 2%. I think a lot of that has to do with some of the expenses that we saw within this report. They were a bit higher than expected. Total expenses there for the quarter coming in at $13.1 billion. The estimate was for $12.88 billion, so slightly higher than what the street had been forecasting. Card rewards expenses by themselves there at $4.43 billion. The estimate was for $4.35 billion. So again, not much higher, but that bar has been set so high for earnings season in general. We've seen this time and time again here for companies that have been reporting this season. If they don't clear that bar and cleared it by a wide margin, they're not being rewarded too much from the street. So the fact that they did fall just below this expectation when it comes to expenses, clearly a bit of a worrisome sign here for investors, at least in the short term. But Brad, you're right. When you take a look at the results, they were very solid here for the quarter. They increased their dividend. They had record levels of spending. Their outlook there was positive on the consumer when you take into account some of the CEO commentary that we're getting here on this call. So again, when you take a look at the spending trends, it really points to the story that we've been talking about now for so many months and so much longer than I think many had anticipated up until this point, that the consumer does remain, on many fronts, does remain resilient and willing to spend, especially the higher income consumer.
Yeah, and we're going to see that higher income consumer, at least the cohort of that, shift in the next few years here. We continue to track the great wealth transfer and what that's going to mean for the shifting of wealth here. And some of the consumers, at least generationally, that American Express is calling out within this, millennial and Gen Z consumers, and in key international markets, they're going to be tracking some of that growth in the premium customer base. That's something that American Express is tracking, and that's something that we'll continue to keep you updated on as well.
You know, and that's so interesting, just real quick. It also ties into some of the commentary that we're getting from the airlines, a space that you cover very well, just in terms of the fact that they are very much tracking the spending trends, more so of millennials, starting with Gen Z too, just in terms of that next generation and where they continue to see that traction, or starting to see that traction in some cases.
100%.
All right, coming up, the top themes to watch as big tech earnings kick off. We've got more on that coming up on Morning Brief.
Meta shares moving after CEO Mark Zuckerberg announced in a Facebook post that his company will invest between $60 billion and $65 billion in capex related to AI this year, capital expenditures, well above the figure that analysts had been projecting. Investors, they were expecting capital expenditures of $1.3 billion. This is according to estimates from Bloomberg. As we're continuing to keep tabs on Meta shares here this morning, they're up by about 1.4%, but I think there's no doubt from investors that if Facebook is earmarking this tens of billions of dollars figure, that the payoff that they're anticipating longer term will perhaps at least give them, 4, 5x, maybe even 10x that on the longer extent period of time, because it's not just a one area that they're deploying that into, especially if you consider all the elements of their business that are going to be dependent upon AI in the future.
Yeah, exactly. And just in terms of how much this is exceeding analyst expectations, at least according to estimates compiled by Bloomberg here, the average analyst we're expecting was $51.3 billion, so significantly more than maybe what had been anticipated. But it's no denying that this is a massive effort, and that was the exact words that Zuckerberg used in a post that he posted here this morning, talking about some of these efforts, what exactly it is going to look like. He says that the plan is to build a data center, quote, so large that it would cover a significant part of Manhattan. He also went on to talk about some of Meta's plans to bring around 1 gigawatt of computing power online in 2020. 2025, also projecting to end the year with more than 1.3 million graphics processing units, GPUs. So again, a massive effort being undertaken by Meta. And again, when you talk about maybe how this is going to pay off in the long run, it certainly is a bet that we have seen from so many of these larger tech giants as we get these massive, massive spending plans on AI with no sign of it slowing down. It doesn't seem like, at least at this point, anytime soon.
We've gone from year of efficiency to in 2023 to make it rain in 2025, essentially, on that AI.
They certainly are. Again, taking a look at shares of Meta here in early trading. You're looking at a bit of a move to the upside here, which is interesting when you take a look at the fact that they're planning to spend more, up just about 1%. All right, big tech earnings on deck next week, kicking off Microsoft, Meta, and Tesla on Wednesday, followed by Apple on Thursday. Investors looking for details on how companies are monetizing AI and how President Trump's policies could impact their bottom lines. Joining us now, we have Dan Ives. He's Wedbush Securities Managing Director, Global Head of Technology Research. Dan, it's great to have you. So we had the update from Meta here this morning just in terms of their spending plans for AI exceeding the street's expectations. Is this a sign of just what's to come here over the next week or two?
Yeah, look, I think it's just get the popcorn out. Because in my opinion, this is the start of this massive build out of AI CapEx that I think the street's massively underestimated. I mean, think about the 80 billion number from Microsoft. Now you got Meta, and it's the multiplier. For every dollar spent on NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. That's bullish for tech. And of course, with Trump and Stargate, I think it just shows this fourth industrial revolution just starting.
You hear of a $60 billion type of spend that is coming forward from Meta on that AI. What is the multiplier for Meta for those dollars that are going out and being invested into some of their efforts?
It's about use cases, because ultimately when you look at Meta, the AI capabilities on advertising, on subscriber growth, on ultimately building out businesses that don't even exist today. Because it's all about monetizing that install base. And there's no different than the way that the hyperscalers have done with Microsoft, Amazon, Google. And now it's going to start playing out on the consumer side. And I think, look, Zuckerberg and Meta, they're one step ahead here in terms of where this is all heading. Clearly, Google's heading down the same path. And I think it just shows the street is underestimating what the growth's going to look like for tech, not just next week, but for 2025, 2026, where I think tech stocks are up another 25% this year, especially with a lot of the regulatory sweep the legs, in the Karate Kid reference, in terms of where that's all been going.
Let's talk a little bit more about the regulatory efforts in the Trump administration, maybe the impact it's going to have on some of these names. Let's kick it off with Tesla, since we're getting those results on Wednesday there. They've been the outperformer, the Mag 7, since we got the election results here of Trump. Dan, I'm curious, why is it viewed as such a catalyst here for Tesla, given the fact that we are going to see a bit of a clawing back here of some of those Biden-era policies that were very pro-EV?
Yeah, look, I think when you look at the $7,500 credit, and that's more of maybe a negative for new entrants, Detroit Big Three and others. For Tesla, the game here, I think 90% of what's going to drive the stock, it's the autonomous and the AI future, because that's the ultimate story here. Because when you think about it, I think the autonomous piece could be worth $1 trillion alone. The biggest issue has been regulatory. That now is going to drastically change under the Trump administration. Obviously, Musk playing, I think, a strong role in terms of where this is all going. And that's why I think the stock is actually underestimating what this is going to do to the story in terms of cyber cabs, autonomous, FSD, robotics. And that's why I think there's a $2 trillion market cap. Next week starts what I believe is going to be a massive year ahead.
A lot of that regulatory red tape, though, has been delegated to the states with regard to the full self-driving and implementation on the roads. So to what extent do you expect a federal force to come forward and rescind that from the states, and then it add into Tesla's outlook?
I mean, you nailed it, Brad, because, to me, that's where it's all going. It's going to be taken to the federal perspective, federal roadmap. Ultimately, where autonomous is going to go, you're almost going to need like a federal license to operate it, even on a fleet perspective. The states will have a role, but it goes back to you have to take it away from the kids at the little kids table at Thanksgiving. Federal needs to actually rule this, because that's why when you look where this has gone, it's gone nowhere. And it speaks to like Trump coming in, a lot of these AI initiatives that start with Stargate. Autonomous is going to be the next piece, I think, in terms of a federal roadmap coming out. And that lays the groundwork for what's going to be a new age, when it comes to not just for Tesla, but I think when you think about Waymo and others and just overall autonomous.
All right, Dan, real quick, we only have about 20 seconds here, but also Tesla launching that new Model Y in North America and Europe. What do you think that pricing strategy is going to look like, just given the fact that we have seen consumers and many of these companies slashing prices in order to boost that volume?
It's a barbell. That's one, and I think they'll have the sub $35,000 vehicle they'll announce first half of this year. They're in a massive position of strength, but as we always say, haters will hate. But I think this is ultimately a stock that has a massive run this year. A lot of tailwinds, autonomous front and center.
Dan, thanks so much for taking the time. Look,
thank you.
I guess I'll have to take a ride in a cybercab one day once they're available.
By next year, you'll be in a cybercab. Late next year, you and Saz will be in a cybercab.
Sounds good. We'll put it to the test. Thanks so much, Dan. Appreciate it. All your markets action ahead. Stay tuned. You'll be watching the Morning Brief on the other side of the short break. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Wall Street is bullish on preliminary fourth quarter results from Twilio. The cloud firm reported that it will see revenue growth of 11%, topping analyst expectations of 8%. Twilio also announcing a $2 billion share buyback plan, the advanced data coming out of the company's Investor Day Thursday.
And Verizon beating on the top and bottom line in the fourth quarter, reporting adjusted earnings per share of $1.10 versus $1.09 that was estimated. The company added nearly 1 million postpaid mobile and broadband subscribers in Q4, their best quarterly result in more than a decade. Verizon targeting wireless service revenue growth of 2.28 to 2.8%. Sorry about that. For 2025. Again, you're looking at gains of just about 0.9%. Catalyst is coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, the latest inflation data showing a mixed picture of business activity with some signs of sticky inflation under the hood. We'll break those numbers for you.
Plus, OPEC Plus has not responded yet to President Trump's calls for lower oil prices. What's next for the energy sector?
And as the market digests Trump's first week in office, we'll tell you how to hedge against any volatility to come. S&P Global Flash PMI data giving us a bit of a mixed picture of business activity for the month. Inflationary pressure intensifying in the month, but employment rising to its highest reading since 2022. Growth moderated in services activity as well, and you can see manufacturing data coming in above estimates for the month, seeing signs of a bit of a recovery in that area, which has been under pressure. Joining us to discuss those headlines and more, we've got Chris Williamson, S&P Global's Market Intelligence Chief Business Economist. Chris, thank you for being here. I want to get your take on this kind of mixed picture that we're seeing, and specifically what it tells us about the stickiness of inflation. What's your read?
Yeah, there is definitely a mixed picture, but most importantly, in relation to current output and what companies are expecting. We've heard all about animal spirits and so forth, and that's clearly evident here. So in terms of current growth, yeah, we had a slowdown apparent in January compared to really strong growth late last year, and that was led by the domestic focused services economy. Manufacturing, though, has re-entered some growth territory. It's only modest, but for the first time since last summer, manufacturing's now moved into expansion. But what's most important is we've seen future output expectations, what companies expect their own output to be in a year's time, really surge higher in that manufacturing sector. So they're clearly expecting the modest growth we've seen in January to build momentum as we go through the year. Also elevated expectations in the services economy. It's down a little bit, but near 3-year highs. So future output expectations are very strong. Now, this has been matched by a revival of hiring. So hiring's up at the fastest rate for 2.5 years in January, as companies are looking to really expand capacity in line with this optimism. But there's a cost come to that, and that is that wage growth in particular and some higher fuel prices coming through, pushing up these price indices a bit. So something really to watch there.
So then, Chris, I'm curious just to get your reaction to the bond market's reaction then to this. Very much it seems to be shrugging it off when you take a look at the equities reaction. We're not seeing a huge move to one side or the other on the back of this report. What is that indicative to you just in terms of current market sentiment and maybe what this signals about what's next?
Yeah, well, although these inflation numbers are ticking higher, they are still broadly consistent with the Fed's 2% target. So it's something to watch as we go on. It's not ringing alarm bells yet. There's just a little bit of upward price momentum coming through there, which in some respects is a good thing because you want companies to have pricing power. So it's good for a profits indicator that the economy is continuing to grow and firms are doing this without having to discount. So there's a positive signal there, but it's just something to keep in mind. Let's keep watching these indices come through the years to whether if they continue to move up, and if you see some further labor market shortages in particular start to push those wage rates higher, then we could see some red flags. But at the moment, it's fairly benign.
And of course, we're seeing stocks hitting record highs on President Trump's first week in office. I want to get your take on something he said at the World Economic Forum this week.
The EU treats us very, very unfairly, very badly. I love the countries of Europe, but the process is a very cumbersome one. And they do treat the United States of America very, very unfairly.
Chris, of course, this comes in the context of a lack of clarity on what Trump's tariff positioning could look like under his administration. What does a potential U.S.-EU tit-for-tat on tariffs mean specifically for the U.S. exceptionalism trade that we've seen doing so well?
Well, without getting sort of bogged down in too much speculation around what it means, I think when you look at the business situation, there's not a lot of concern there at the moment. So the PMI that we've just had out for the US, we had an earlier one out in Europe, in fact showing manufacturing sentiment, notably in Germany, really starting to pick up. They are moving into 2025 thinking, hey, hang on, we've not had tariffs slapped on us yet. We've got some lower interest rates coming through in Europe. It's going to help drive growth. And I think companies are really looking at, let's see what the domestic drivers are doing here. And they're starting to look more positive in Europe at the moment. So downplaying some of those tariff concerns that have been really heightened late last year. Of course, we can only speculate what might be implemented by the new US administration going forward. And clearly there's some noise here around what might take place. But at the moment, we can only work on the basis of what's actually been announced. And it's not a lot so far in relation to Europe.
Chris, just given the U.S. exceptionalism standpoint, just in terms of maybe where the U.S. economy stands relative to the rest of the world, there certainly has been this argument, we've heard it from a number of our guests this week, that this very much gives President Trump more room to negotiate and ultimately get what he wants. I'm curious, how is the rest of the world viewing that stance right now?
Well, I mean, I can't put words in their mouths, but what we can see by the data is that certainly that gap narrowed a bit in January. The rest of the world doesn't seem to be falling apart and panic about what to do about this. They're taking a more measured approach. We can see the business sentiment levels in the PMI data. They're holding up. They're low. They're weak. It's subdued growth in Europe. Japan, also some subdued readings there, but things are, again, they're holding up. So it's a case of seeing what President Trump actually enacts in terms of his tariffs and his other threats, and then take a measured approach to how to respond to those. But at the moment, as I say, the reaction, certainly from the business environment, has been one of not panicking, carry on as normal, and look to domestic markets, perhaps more than the US, as to where you can grow your business.
All right, Chris, thanks so much for your insight there. Have a great weekend.
Thank you.
The S&P 500 hitting a record high this week, on track for its best start for a president since 1985. Now, the moves this week coming even as investors brace for potential tariffs and weigh growth policies versus some of those escalating trade tensions. Here's some of what President Trump had to say on the matter at the World Economic Forum earlier this week.
But if you don't make your product in America, which is your prerogative, then very simply you will have to pay a tariff, differing amounts, but a tariff which will direct hundreds of billions of dollars and even trillions of dollars into our treasury to strengthen our economy and pay down debt.
So here with more on the market's reaction to President Trump's first week in office, we have Daniel Morris. He's the chief market strategist with BNP Paribas. And Daniel, it's great to have you here. Let's talk about the market's excitement. I think it's fair to say, just in terms of the performance that we've seen this week. You've got the S&P at a record high this week. You've got the fact that we're off to the best start, like I said, since 1985 for a first president. What does this signal, just in terms of market sentiment, and maybe whether or not this momentum can carry over?
Well, certainly what we're still seeing is that change in expectations from what most people probably had prior to the election to immediately after, and even now, other than that key pivot point, if you will, from November 4th, it was the announcements that came post the inauguration. A lot of concerns prior to that. We'd seen many statements talking about many things, and you didn't really know what you would actually get. And frankly, so far, it's been on the lower end, if you will, of what might have happened. We'll see what comes next. But I think that's also been a help for the markets. If you look at volatility indicators, both for equities and fixed income, they've come down since the inauguration, kind of giving investors having a bit more confidence about the outlook than they had before.
Yeah, it makes me wonder if the inauguration was kind of the market's last big question mark, at least in the short term, ahead of some of those big tech earnings. But I want to get your take specifically on the corporate tax rate, and this came up in Trump's remarks to Davos. Should the market be pricing in a 15% corporate tax rate already?
I think that might be a little bit too aggressive. We've got to remember that when it comes to tax policy, it's going to be Congress that decides what happens, as much as Trump can propose, number one. And number two, this isn't going to be happening anytime soon. So I guess it may be kind of a distant factor for the markets, but I think in the near term, we're going to be looking much more at domestic growth, look at what happens on tariffs, on immigration, because that we can assess much more readily. Whereas I think any of the tax implications, frankly, that's going to be a second half of the year story, I imagine.
Daniel, when you talk about the net impact here on the U.S., I guess, to what extent is it going to be beneficial for growth? And I think that's the key question that so many investors are trying to figure out at this point.
Well, that's it. If we talk about any of the key issues, again, tax, tariffs, immigration, all of them are going to have different effects on growth and on inflation, some positive, some negative. And where we end up after all of this, certainly impossible to assess now, and it's going to come down to those details. And I think that explains, you talked about volatility, and even if it has fallen a bit recently, in general, that is going to suggest the markets are going to stay volatile, because any changes in expectations around those different policies, what's actually proposed, what can actually be implemented, could have very significant implications and impact on what those expectations are for profits.
And specifically when it comes to the tech trade, we're seeing some move to the upside in a lot of the big tech names off of this announcement of more CapEx from Meta this morning on AI specifically. What do you think about the trajectory for the Mag 7 amid some of the policy unknowns that we currently have? Will the Mag 7 continue to be cemented as this sort of safe haven trade in 2025?
Well, we don't focus specifically on the Mag 7. Our allocations in the U.S. are to the Nasdaq, and it's very much in the view that there's going to be opportunity in that broad set that we want to be exposed to instead of having something that's too concentrated. What I'd highlight, though, if you look at the trend of expectations for earnings for the Nasdaq in the, say, 6 months prior to the election and what we've had since, you actually have not seen that much of a change in the trend. I.e., it was positive, and it's positive now. You haven't seen a big impact. So that suggests that these fundamental drivers, particularly around AI, that hasn't necessarily changed all that much in investors' minds. That's clearly supporting the market, and we anticipate it will continue to do so.
And Daniel, talking about supporting the market even beyond big tech, what do you make of the earnings season so far and whether or not this is really going to be that key catalyst to keep that movement to the upside?
I think the most interesting message we've seen so far in the numbers that we've had. So numbers are good, expectations high, but so far positive earnings surprises. That tends to be the way it goes. But you have a much better breadth across the different indices than we know we had last year, where a lot of it was driven by the Mag 7, particularly at the beginning of the year. If you look at earnings for Nasdaq, or as many companies have reported so far, for value stocks, for small cap stocks, you see a much more similar rates of growth across the different indices, different styles, different sizes. And that's actually, I think, should be comforting for investors that you're seeing a broadening of that earnings momentum in the U.S. market and not such the degree of concentration that you had last year.
All right, Daniel Morris, great to get your insight. Thanks so much for joining us. Coming up, President Trump's proposed tax and energy policies and what that means for investors. We got a breakdown for you when we come back.
My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth. We're bringing them down very substantially, even from the original Trump tax cuts.
That was President Trump promising tax cuts while speaking at the World Economic Forum in Davos, Switzerland, to the World Economic Forum in Davos, Switzerland. But he needs Congress to make that happen. Joining us now to talk about the path ahead, let's bring in Illinois Congressman Sean Casten. Congressman, it's great to have you here on Yahoo Finance. I'm going to guess that you're probably opposed to some of the tax cuts efforts that have been proposed here over the last several months, and some of the policies that we've heard from President Trump. But I'm curious just in regards to the corporate tax cuts. How are you viewing just the argument that that would substantially really help U.S. competitiveness here on a global scale?
It's hard to make that argument, but let's review back to what happened during the last set of Trump tax cuts. We know it's been said many times that 80% of those tax cuts went to the wealthiest Americans. But what we also know is that when we brought in the global minimum tax, under the Biden administration, all of a sudden the U.S. became a tax haven. And so you've got a bunch of tax lawyers right now who are trying to find ways to help corporations who had intentionally domiciled their companies to recognize their taxes overseas, trying to bring them back to the United States. We already effectively are the lowest tax rate in the world. So we're not doing anything beyond that of just transferring wealth. I would also point out that under Trump's last term, Trump's IRS director told us that we were giving up nearly $1 trillion a year in revenue because we underfunded the IRS, and we were failing to collect taxes due under the current tax law. So we funded the IRS, and of course the Republicans started to pull that back. But the question of what the marginal tax rate is entirely separate from what is the tax that we actually collect. And I think what frustrates a lot of my Democratic colleagues is we can talk about this in some economic theory, but then separately, if we're not going to enforce the laws we have, this is fund the police, for goodness sake. So I think we're all very concerned about the scale of the tax cuts they want, the deficit impacts this is going to have, and the argument that this will grow the economy is simply not borne out by any macroeconomic statistics.
Well, certainly a big concern for voters is inflation. That was cited as the #1 issue for voters on exit polling this election cycle. The corporate tax cuts could be seen as an inflation hedge because without them, corporations could raise prices in order to fund their ability to pay off those taxes. What do you say about the risk of that?
So that argument presumes that inflation was limited to the United States. Inflation was global. The United States actually had slower inflation than most of the rest of the OECD. I was on a bipartisan CODEL to Europe just before the election, and every single European country was jealous of what the United States had accomplished in the wake of all the inflation that happened during COVID. And of course, they were all also saying that their voters voted against the incumbent party because everybody blames the incumbent when inflation happens. The fact that we have brought inflation down faster than the rest of the OECD, and the fact that we have a lower marginal tax rate than the rest of the OECD, means that on the margin, lowering U.S. taxes doesn't actually do anything that's anti-inflationary. The stuff that was really making a difference on the anti-inflationary side, and this is politically unpopular maybe, but it doesn't make it true. The CBO reported that one of the big reasons the U.S. got inflation under control faster than other countries was because we had such higher immigration rates to the United States. And that was allowing us to create jobs without creating as much upward wage pressure as was happening in other countries. Trump's clamping back on that as well, right? And these shouldn't be partisan. These are like objective macroeconomic facts. But taxes are not the solution to all problems and rarely are the cause of all problems, candidly.
All right, well, we don't have a ton of time, so I want to switch gears and I want to talk about energy. President Trump talking about drill, baby, drill this week. Here's what he had to say at the World Economic Forum.
We need double the energy we currently have in the United States. Can you imagine? For AI to really be as big as we want to have it, because it's it'll be very competitive with China and others. So I'm going to give emergency declarations so that they can start building them almost immediately.
And I know you just sponsored a bill aimed at improving interregional electricity transference, and this could help maintain the reliability of the grid. Does your end goal when it comes to increasing the reliability of the grid sort of align with President Trump's?
Well, it does, but we need to speak very clearly about energy. I was talking with one of my colleagues this week that if we asked an agriculture secretary what they're doing about hunger and they said we're planting more corn, we would realize that was ducking the question. when you ask what you're doing to give people affordable, reliable energy, and we say we're going to drill, that's the same. We're shifting to the upstream end of the equation. What we need to be doing is making sure that as we have seen this surge in domestic manufacturing over the last 4 years, as we've seen the surge in AI, as we've seen electrification of the transportation sector, we need to build a much more resilient grid, and we need to make sure that that's providing ways where the lowest cost power can get to the highest demand nodes, which means building out the transmission system. That's very different from what Trump is saying, because what Trump is saying is, I want to focus on the upside, drilling assets. The oil and gas industry is increasingly an export play in the United States. The oil demand in the US is basically flat over the last decade. Oil production is up and it's moving to export. Natural gas is rising, but not rising as fast as GDP, and natural gas exports are surging. So you've got an industry that really wants to build export terminals, not provide energy for Americans. And then separately, you've got energy that can't be shipped, wind, solar, that needs transmission to get to customers. And we're seeing Trump saying that he's going to ban offshore wind. And so I think we really need to understand this, that if we are focused on a pro-consumer energy policy, then we have a lot of constructive areas we can work with the White House. If we are focused on saying we want to benefit producers at the expense of consumers, we need to be honest about that, and I think we need to stand in defense of consumers.
All right, Congressman, thanks for joining us. Appreciate it.
Thank you very much.
Increasing oil and energy production, of course, a major focus for President Trump. Here's what he said about oil at the World Economic Forum.
The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto.
We've seen oil and gas moving to the downside off of those comments this week. Prices recovering towards the end of the week, but oil still set for its first weekly drop of the year. For more on what Trump's energy plans mean for investors, I want to bring in Paul Sankey, Sankey Research Lead Analyst. Paul, great to have you in studio. I want to get your take on energy producers, because Trump doesn't necessarily control what these individual companies do as much as he might like to. What are you anticipating the reaction to look like from those individual companies?
Not a lot. I mean, at the moment, we can't see how drill, baby, drill can be applied to those companies because they're private and because analysts like me, but more importantly, shareholders, are really very closely watching these companies to make sure they don't overspend and they don't increase spending into what looks like a quite oversupplied oil market, generally speaking. And that folds through into Trump's other comments towards the Saudis, because obviously it's difficult for the Saudis to want to lower oil prices when their budget balance is probably more like $90 a barrel and we're below 80. So there's a few internal inconsistencies here that sort of just don't hang together, quite frankly.
Well, does the rhetoric coming from the White House, from the Trump administration so far, does that put any sort of ceiling or cap to the upside here on oil prices, or what we're likely to see over the next couple of years?
I would say it's definitely disconcerting that they keep talking about lower oil prices and lower. I mean, the president keeps saying, let's get prices lower. It's hard to ignore it, you know. And of course, there's a very specific concern about pump gasoline prices. And then at the same time, you've got things like the tariff threat from Canada and Mexico being, our, you know, certainly Canada, our biggest oil supplier. Oil that we also can't replace. You know, this is heavy sour oil that the mid-con refiners can't just turn around and use other oil. So that would, you know, have that's a directly, you know, opposing internal inconsistency. Over time, you know, I think it'll come down to the demand side. So the biggest question is, do you put these tariffs in? Are they inflationary? Probably not. Is the pro-business environment going to be good for the economy, and then does that lead to strong demand? The worry there immediately becomes China, right? Because you've got, you know, the potential for tariffs on China and the weakness of China as being a problem. So it's really conflicting. You know, there's not a simple answer. They want lower prices, but a lot of what they're saying and doing would mean higher prices. And in amongst all that, the companies are sort of just watching with their arms folded. They're not really doing anything. So it's a confusing environment. And as you know, a lot of these executive orders are just executive orders. You know, they don't actually do anything immediately. So it's very much a rhetorical environment. You know, the final answer, we're somewhat bullish here. Basically with winter, we've got strong demand. one of the real surprises was that the Biden administration put much stronger sanctions on Russia and Iran right as they ended, which is kind of can't really fully understand that, but it definitely plays into Trump's negotiating position. So I think we're anticipating a tough stance on Russia and Iran, much more so on Russia than we would have thought 3 or 4 months ago when the market started first discounting a Trump win. So we'll watch those two. Those are the two key supply side ones more than the draw baby draw.
And are they more key than any potential tariff risk with regards to China, like you mentioned?
Yeah, I mean, it's just so hard because you're just bouncing around. I think yesterday Trump was backing off China tariffs, but he's been saying so repeatedly tariffs, it's hard not to believe there's going to be some. What we heard from lobbyists in Washington, and the lobbyists love the Republicans and particularly love Trump, is it's very good business for them because in their particular business, and this is one specific lobbyist, they had applied for exemptions on tariffs and had an 85% success rate for their clients. So the phase after the tariffs are imposed is everybody rushes to get a meeting to get an exemption. So, the extent to which you can capitalize any of this into equity values, that's our issue as stock analysts, is, it's almost like just shut your ears and wait. Because, there's nothing really truly coming out of it right now other than rhetoric.
Well, how should investors then be reading, I guess, just a bit further into it? Given the circumstances, given that uncertainty, given where things stand and what we know about Trump's policies and what he wants from a drilling perspective, who then is best positioned among your coverage?
Yeah, that's exactly how we look at it. So you stay thematic and you go, okay, well, look, who are the obvious winners? And the obvious winners for us, and we cover high capital intensity businesses, is obviously this AI theme and the investment that's going into that, because the amount of money and the scale of the companies, these companies of this scale have never previously existed, much less with the ability to spend this much. And the sheer numbers that they're talking about in the hundreds of billions a year obviously is going to need an absolutely enormous amount of US electricity, and that becomes US natural gas. And that's all very clear, so we love all that stuff. And that's easy for us. Oil and refining is just much more tricky at the moment because of this whole tariff, where are we going, what's going on, the whole dynamic on how tough are you going to be on Russia, how soft are you going to be on Saudi, how tough are you going to be on Iran, how tough are you going to be on China is just impossible. And those are like the 4 biggest moving parts in the world oil market. So that's a tough one. And then, people love the midstream energy, right? Because obviously if you're going to get a lot more volume, which is implicit in a lot more natural gas, it's not even implicit, it's explicit. You're going to need a lot more volume of natural gas. Kinder Morgan's talking about growth of 28 BCF a day over the next 5 years, which is off a base of 100 BCF a day. So a 30% increase in what is already the biggest gas market in the world. You're going to need a lot more pipes. And so people are buying things like Kinder, and we think that makes a lot of sense.
All right, Paul, it's great to have you, especially here on set. Thanks so much for taking the time to join us.
Sure, it's a pleasure.
All right, coming up next, we are taking a look at today's Yahoo Finance's top trending tickers. We'll give you the news behind the moves, some of today's biggest stock movers. We've got that for you coming up next. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, chip stocks are rising. Broadcom, one of the biggest gainers in the Nasdaq on the back of Mark Zuckerberg's announcement that Meta is going to be investing between $60 billion and $65 billion in capex related to AI this year. That was well above what the street has been forecasting there. You're seeing a bit of excitement play out for some of those chip names. Again, Broadcom amongst the leaders here. You've got ARM just above the flat line here. But again, what this is indicative of, and I put that question to Dan Ives from Wedbush last hour, Maddie, and I was just talking about the fact that whether or not this is a start maybe of what is going to be more to come this earnings season. When you talk about the spending from some of these tech giants, especially the hyperscalers, what that planned spend is going to be, much of that has been scrutinized in terms of, or very much looked at from the street as a key catalyst and growth driver here for obviously so many of these tech names and chip-specific names over the next several quarters. But again, when you take a look at the announcement that we're getting from Meta, Ives making the case that this is just the start of what we are going to hear from so many of these tech giants, and AI spending is here to stay. It's a priority here for so many of these companies, and very much that story, what we have heard over the last couple of quarters, is going to stay intact this earnings season.
I think it's interesting that Ives is saying that we're going to hear more announcements like this because of how weird this particular announcement was. Zuckerberg going on Facebook, making this post, and if we have the quote, I want to pull it up right now so we can take a look for our audience here. But he announces this on Facebook a week before his own company earnings. Why is that? This is exactly the type of thing you'd usually say in an earnings call, but instead he took matters into his own hand with the post. So it's going to be interesting to see if we see more of that from these tech executives. And here you see this quote, Meta building that 2 gigawatt data center, planning to invest 60 to 65 billion in capex this year while growing our AI teams significantly. That last comment too, I also thought was interesting, given that just a couple Mondays ago we had Meta announcing those layoffs of underperformers. Are we going to see them devoting capital a little bit differently internally as they look to hire more AI expertise and bring those kinds of workers on board, as opposed to having what they see as underperformers as they go into this AI transition?
Yeah, certainly. And as you're talking here, I'm just taking a look at the quick reaction that we're getting from others on the street. Very much they are upbeat just about these spending plans. And I was curious about that because we've seen a bit of a different reaction, at least play out from the street, when we've seen some of these capex spending plans exceed, very much exceed what the street has been looking for. But in terms of what this means for future growth, Stifel basically making the case that, yes, it was at the high end of investor expectations, though I do imagine that plenty of folks were at the north of that range. Vital Knowledge went on to say that they think it's going to be okay because revenue, if Meta's revenue forecast is as far above plan as the capex was, then investors are obviously going to be happy. So they're going to be able to maybe look past some of the immediate or shorter term spending plans that could potentially or would have potentially caused a little bit of discomfort maybe from some shareholders.
Yeah, especially after all of that efficiency from Meta, seeing more spending perhaps seen as a boon for a lot of AI names this morning. All right, next up, the maker of Guinness and Johnnie Walker, Diageo, is exploring big changes according to Bloomberg. The company considering a sale or spinoff of its Guinness business and reviewing its stake in LVMH's drinks unit. Diageo looking for ways to spark growth after seeing sales in the U.S. and China slowing last year. That stock up over 4%. It's interesting, though, that they're weighing these options for this Guinness brand, particularly in the context of the company reducing their medium-term guidance. Seems like they have been struggling under the weight of, all of the things that we talk about all the time. Inflation making consumers buckle. Also, the fact that they do have so much exposure to LVMH, around 30% stake in MH since 1994 here. They've talked about interest in acquiring Moet Hennessy, of course, one of LVMH's brands previously. Now, interesting to see whether or not a full acquisition could potentially put too much strain on the company's balance sheet. And perhaps that's why they are seeking out some optionality for this beer brand.
Yeah, and we have a relatively new CEO at the helm, been there just about a year and a half. But when you talk about some of the underperformance that we have seen from Diageo's brand. Maybe this is going to be that key thing to unlock some of that growth that has been missing as we take a look at some of those longer term charts up on the screen here. But in terms of what this could mean, we saw the initial reaction. Shares actually popped almost 7%. We were looking at the biggest intraday jump, just to put this in perspective there for our viewers, the biggest intraday jump that we have seen now in just about 4 years. We're now off of that just a bit, up about 4%. Very much though unknown. It was important to point out that no, obviously final decisions have been made here. There's some question just about whether or not this is, even some of these deliberations, if this is going to lead to any of these deals and what exactly that roadmap looks like here for Diageo. But again, when you talk about not only Diageo being under pressure, the industry as a whole being under pressure, when you talk about the younger generations are not only drinking less, but drinking a little bit differently just in terms of their patterns and what we have seen from older generations. And many of these companies have had to pivot their strategy just a bit. So again, Diageo will be important to watch how this all plays out, and also just what that interest, if they were to sell it off, what that interest is going to look like for a brand name like Guinness.
Yeah, really good point.
Finally, shares of British fashion house Burberry higher after reporting a shallower than expected decline in sales. They were down 4%. Analysts were actually expecting a 12% drop. The company is undergoing a revamp. The CEO saying that he is encouraged by consumer response to the new lines, but there's still work to do. You're looking at gains of just about almost 10% there here for Burberry. The sales in America is unexpectedly climbing. China, though, falling just a bit, coming in just below the street's expectations here. Looking at gains just about 9%, so off the highs of the morning. They have been up about 16% earlier here. But again, when you take a look at the road ahead, especially some of the troubles here in China, very much pointing to the fact that there is a lot to be encouraged about in this report, but some of those more challenging underlying stories here within some of these luxury consumer names is still continuous of a pattern that we've seen here in recent quarters.
And it's interesting because this also helped lift European equities more broadly, which have been under pressure from some of these luxury names, which of course, as you mentioned, Shauna, are really under pressure from that lack of strength from the Chinese consumer. Perhaps these results, yes, coming in better than expected, but it's fascinating to see the amount of bullishness in the street's reaction here, given that we did see almost a double-digit decline in sales in the APAC region. Getting some analyst reaction here, RBC saying we view these results as a first and early step in the right direction. And they talk about, this is interesting, we've seen this kind of shift towards in-person commentary from these analysts. They mentioned that. They talk about relating to store layout and presentation, focus on core products, and contribution from markdown activity, all contributing to this move to the upside. I think it's interesting that we keep hearing commentary on the in-store experience, especially for these luxury brands. I guess that makes sense.
Yeah, I guess it does make sense if you're spending that much and maybe you're more willing to go in-store and everything. But when you talk about promotional, that was so interesting because that was something that a couple of analysts have pointed out in the reaction to these results and floating the question as to whether or not it is going to have some sort of deterioration in terms of the brand's exclusiveness and whether or not it's going to have maybe a more long-lasting effect when you take a look at the fact that some of these promotional discounts that were available were up to 50% here the last quarter. So yes, it did help in the short term, but they did pose a question as to maybe the longer-lasting effects of this. I don't know. It's still pretty expensive with 50% off.
Right, exactly. It's still an exclusive group of people that can afford the products. Nobody freak out. But definitely interesting to see this sales figures coming in here from Burberry. All right, well, coming up, Fane, Magnificent Seven. We've also got Batman in the mix. We're going to revisit some of the market's favorite acronyms and find out which outperformed the rest. All of that next right here on Catalysts. From FANG to the Magnificent Seven and now Batman. People have long loved giving nicknames to indices of the biggest market stocks and moving names in the stock market. But what's behind the crazy acronyms and which have outperformed the rest? Here with the retrospective, we've got Jared Blickery. Hey, Jared.
America is obsessed with its trillion-dollar companies from Apple to Nvidia, but in the beginning, there was FANG, the index coined by Jim Cramer back in 2013. It was a pivotal time in the markets. If we go to the Wi-Fi Interactive, I'll show you. The S&P 500 was just climbing out of a nasty secular bear market. And let me just draw this on a chart here. This is 2000 to basically 2013, and it was finally poking above that double top that was created by the dot-com bubble and the housing bubble. Over a decade of investor frustration, finally gave way to a secular bull market that was brand new. It would find its winners and losers, but in the zero interest rate environment of the times, growth stocks would rule the markets, and some of the biggest gains over the next decade, they would be concentrated in just a few companies. So FANG was just the beginning, and let's break it down. It was the start of something big. Amazon was riding high thanks to its new cloud business. Netflix had successfully pivoted to streaming from the old mail-in your DVD paradigm. Google was a juggernaut and was about to be reorganized into Alphabet. And Facebook, it was a new public company, but was already a veteran at dominating social media. The common thread here, these were companies about exponential growth in an era of super cheap money. From 2013 to the present day, FANG would go on to return 1,585%. That compares with a very respectable 300% in the S&P 500. By 2015, Apple was dominating the smartphone space and catching investor eyes. It had finally broken to new highs after 2 years of sideways action, and as the largest company in the world, it was natural that investors would want to shoehorn Apple stock into the mix, and that's how FANG was born, with a long A. Apple has no doubt been a juggernaut long term, but the swings have been crushing active investors. Over the next 3 years, it only returned 12%, and since 2015, it has had 4 declines of 30% or more. So when we tally the FANG totals up from 2013, it's up 1,028%. It's over 3 times the S&P 500, but well short of the original FANG's 1,500% and change. Now, we got to talk about the New York Stock Exchange FANG index for a minute, NYSE FANG. It was born in 2017, and it's a managed index that rebalances each quarter. It has the names we've been talking about, plus CrowdStrike and ServiceNow currently. Now, back in the day, it even had Twitter, but it would be a bit apples to oranges to include in the mix, so we move on to the post-pandemic. And now the moment you've been waiting for, it's 2022. The Fed is still hiking rates, trying to quash inflation, but the market is forward-looking, and a new bull market is being born. The undisputed leaders, the Magnificent Seven, dominating index returns to the point where we hear frequent warnings of the dot-com boom and bust. These 7 stocks, now including Nvidia and Tesla, were the market. Since October 22, since that bottom in the market, Nvidia is up a staggering 1,200%. And from the beginning of 2023, the much more volatile Tesla, it is up over 300%. From 2013, the Mag 7 returned 1,487%, trouncing some of the other groups, but still not quite reaching the heights of the original 4-company FANG guys.
Yeah, Jared, and so you talk about so much excitement, the outperformance of some of these tech names. Clearly, investors, they don't want to let it go just yet. And I've heard some rumblings of actually a new name that's out there now.
Yes, it's been a while it's been out there in the mix for a little bit, and investors do love to shake things up. And I know we've had at least one new entrance into the $1 trillion club recently. And by 2024, guess what? These Mag 7 stocks were still riding high, but there was that new winner. Chipmaker Broadcom was now in the $1 trillion market cap club, so it grew to 8. Mag 7 to 8. With Broadcom, the new tally topped 2013. It was up 1,500%. But critically, this is still 10 percentage points shy of their original 4's results. So when we look at the final tallies, it's clear that sometimes you just don't need to mess with the original if you've got a winner on your hands. But in case you're wondering, and you're a new investor, and this is your first bull market, thought you'd be interested to know that if you measure all of the group's returns starting at the beginning of this bull in October of 2022, Batman is the big winner with 146% return, and FANG comes in a close second with 140%. And the Mag 7, it's still close behind, but still in third. And in this day and age, the bronze medal, that ain't too bad. It's up 137%, guys.
All right, Jared, I'm sure that took a lot of time and a lot of work. We appreciate you breaking it down for us, giving our viewers a better perspective of some of the gains and the outsized gains that we've seen from just a handful of names. Jared, thanks so much. Coming up, why our next guest is saying that investors can use options to combat increased market volatility, especially as we head into earnings season. We've got some of those top plays for you when we come back.
Investors have a lot more than just stocks at their disposal these days, but one potential trade they may not have gotten into just yet is options. Our next guest is watching several issues he thinks could cause more volatility across several asset classes: China and tariffs, interest rates, M&A, and energy and financial sector movements as well. Here to tell us more, we've got Luke Rabari, Equity Armor Investment CEO and Portfolio Manager for an options segment sponsored by Tasty Trade. Luke, thanks for being here. So talk to me about why investors should consider getting into options, particularly as a way to play volatility.
Well, thanks for having me. Options have always been a good tool to try to manage your portfolio or try to manage the downside risk of your portfolio, or even try to take advantage of some of the potential upside of the portfolio. So a lot of times, just like today, you might have a stock position that you're nervous about, and you might want to say, I don't know if I want to sell it. Maybe I should try to set a price where I want to sell it. What if it doesn't reach that price? You can sell calls on that stock and get called away or earn that income when you do. Today, I'm going to talk about puts. And what I use puts for are my yield play. So in our models, in our mutual fund, we're long stocks and long volatility, and it gives me a chance to use options on single names to try to take advantage of some of the volatility in the marketplace and kind of get into stocks I couldn't get into before, or at least take advantage of those stocks rising if they're a little too high right now by selling protection.
Luke, what are some of those names that you're getting into?
One of them right now that I like is Honeywell. Honeywell, as you know, is an activist play currently with Elliott Management. Elliott, a well-known hedge fund manager, really great at what they do, and they usually get what they want. And right now they're pressuring Honeywell to try to get the business more aligned, either sell some of the business, maybe even do a stock split. And any of those things will make the stock go up. When's that going to happen? When does that pressure start? When do they actually do this stuff? I'm not sure, but I do know that it sets a pretty good floor for the stock, and I'm willing to sell some downside puts and get some yield out of that. And if it does go lower and I get assigned, I don't mind, because I own the stock lower, even though I don't think it's going to go much lower than where it is.
I know another name that you're looking at that has certainly been making headlines this week is Oracle. Talk to me about the play there.
Yeah, Oracle is a blast from the past. I was a specialist on the options exchange for Oracle, I think before you guys were born, in the .com days. But Oracle right now, it kind of has everything going for it. It's starting to get mentioned as one of those names with Amazon, with Microsoft, with Google for cloud and also data storage and server storage. And I think it was last year when TikTok's CEO was in front of Congress and they were asking questions. And the TikTok CEO offered to move all their servers to the US on Oracle servers. So I think this is going to happen. I think it's going to be great for Oracle. I think it's going to be a lot of business for Oracle. And Oracle right now it's had a big run over the last couple of days, especially, and it is a little bit expensive. But when this TikTok thing happens, and I don't know when, it's really going to benefit them. So that's why right now I'm very comfortable selling puts in Oracle. I think the business is going to be good for a long time. And if it goes lower, if it happens to go lower, I don't mind owning it.
All right, Luke, thanks so much for giving us some insights, some trades for our community to think about.
Thanks for having me.
Coming up next, it's Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Stay tuned.
It's time for Yahoo Finance's Market Minute. Stocks are lower to end Trump's first week back in office. Shares of Novo Nordisk jumped more than 9% at market open. The company's new weight loss drug delivered better results than that of its blockbuster products, Wegovy and Ozempic. Results show weight loss of up to 22% in early-stage clinical trials. Shares of the cloud communications company, Twilio, jumped more than 20%. Analysts believe it can become a much more profitable business as it expands into new areas like conversational AI. And Texas Instruments issuing a weak forecast for the current first quarter, hit by sluggish demand and higher manufacturing expenses. Still, the company beat expectations for the fourth quarter. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, investors are on edge to see how President Trump's promised policies could play out in the markets and the economy. But we're going to talk to one portfolio manager who says you should avoid heavy portfolio changes based on your assumptions. And higher mortgage rates are likely to keep weighing on the existing home sale market despite home sales rising in December. The figure on an annual basis that actually fell to its lowest level in nearly 30 years. We'll break down the latest data and talk about the tips for your weekend home shopping. Plus, tax season officially kicks off on Monday. I'll sit down with a tax expert to discuss everything that you need to know to prepare all that and much more during today's show. But first, let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks slightly lower today. The S&P 500 pulling back from a new record, though. Joining me now, we've got Matt Powers, Powers Advisory Group Managing Partner, joining us here, a good friend of the show. Matt, good to see you. You say that you're avoiding heavy portfolio changes right now. Explain that.
Yeah, good morning. So, we've got a big week next week. There's a lot going on here. We'll see mega cap earnings minus NVIDIA. There's a Fed meeting, PCE report, which we know is the Fed's preferred inflation gauge. And that's all following a busy week this week. So there's plenty happening. Energy, materials, industrials have jumped year to date, which is to be expected under the new regime. But Trump's policies and some uncertainty of where they'll lead are clearly pushing stocks. As like any year, equity markets should be shaped by a mix of different things. So we've got a few things on our radar.
And so all that in mind, Matt, as we're taking a look at some of the fresh records that have been notched this week, and namely thinking about the S&P 500 here, off of fresh records, what should be the natural inclination or mindset that investors continue to keep?
Yeah, it's one theme, and this hasn't changed, is mega cap valuations being stretched. And it's one of the more common conversations we have with clients with their positions when they become overconcentrated is what to do. And we just continue to own mega cap AI trade. And in any kind of company that's a derivative of that, software, utilities, there's definitely tailwinds from Trump's pro-AI stance, and there's no reason that they can't remain expensive. I mean, history shows the market can hold high valuations. The concern here at Catalyst, and we could potentially see it next week, are for this to turn to be a big earnings miss. And again, most of these report next week.
And so as we're thinking through some of the tech companies that are going to be reporting next week, we've also got tech earnings. We've got, of course, a Fed meeting that's going to be taking place the first of 2025. How do you think that'll set the tone for trading as we look out into the rest of this quarter and the first half of this year, especially as we're not expecting or anticipating a cut until the back half of this year, it seems?
Yeah, it's kind of that same theme that it has not changed. The Fed interest rates have driven the markets. They're unlikely to cut next week. March, May, even June seems more likely, but the stronger job market coupled with recent CPI data are mixed signals as to what the FOMC will do. Again, job market looks pretty solid, and the Fed probably won't cut rates as much as people thought a few months back, but it's simple. I mean, they've got a 2% target by the end of the year. The Fed penciled in 2 rate cuts for 2025, its December meeting, and that stance hasn't changed. Investors just really need to be patient.
How does a 2% target from the Fed inform some of your stock picks right now, and who's kind of top of your list?
Yeah, so one sector which has been in favor, out of favor, financials. And we probably drill down specifically to regional banks. That shares have climbed clearly in pushing valuations higher, but the underlying fundamentals remain solid. We like the environment there. It's, the cost of capital's fallen. M&A activity has certainly anticipated to certainly increase. Wealth management has experienced growth, and asset management's gained because of a stronger market. And Trump's pro-deregulation stance in his second term should support the sector. So we, again, specifically regional banks, and if you want to get broad-based exposure, you can look at IAT, which is the iShares U.S. Regional Bank ETF, PNC, U.S. Bank, M&T. Those are all holdings that we love, and they're some of the top holdings in the ETF.
What type of, do you anticipate any massive consolidation as you're looking across not just deregulation, but also for the regional banks, any tie-ups that could make sense?
Yeah, I specifically no. I can't pinpoint it. And again, we have to wait to see where this, we know the stance that Trump has, but what policies will be in place. And, I just think that, again, M&A activities should increase this year. And that's where, if you drill down to regional banks, they could benefit more so than the mega banks, the large banks. It's, we can go to it. You can drill down even further and look at specific holdings. But again, the IAT is an easy way to gain exposure in that area.
Matt, thanks so much for taking the time here today. Good to see you.
Thank you, Brad. Good to see you too.
Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Market Domination co-anchor Julie Hyman joining us here on set. Julie, we got to talk about Netflix and what's going up there. Getting an upgrade at Bernstein, the analyst actually lifting the stock to outperform from market perform following that blowout fourth quarter. It's certainly going a little viral, especially for the pricing too that's going to come forward that a lot of subscribers got wind of.
It's interesting because earlier the stock was up and now we're seeing it pull back a little bit. It did rise to a record yesterday after its earnings. And then there are a lot of actually firms coming out and raising their ratings on it, raising their price targets. Bernstein's price target is actually $1,200 a share. Versus it's below $1,000 now, as you can see there. Laurent Yoon is the analyst there. And he said, there are still a lot of questions about long-term drivers of the company's growth. But he said, quote, what we do know gives us sufficient confidence for a much delayed upgrade, even at the current price point. So he sort of acknowledges he's been behind the ball here, but he says even with the stock at a record, they still would get in here, which is pretty notable, I think. Yeah, shares cracked $1,000 a share yesterday, too, and they said at the top of this note, imagine someone had a $1,000 price target for Netflix a year ago and it was trading under $500. Math alone would not have supported that price target, but even with the most bullish estimate for 2024 or even 2025 at the time, target requiring unwavering faith, and it seems like they are exhibiting some unwavering faith for that $1,200 target that you mentioned a moment ago. Yeah, it does seem that way. I mean, analysts are pretty overwhelmingly positive on the stock as well, we should note. And it's up something like, 80% over the past year. All right, more Beyonce bowls maybe could help them get to that target. Maybe. Let's also talk about NextEra Energy reporting fourth quarter earnings results, falling short on the top and bottom line. Shares, though, still higher by about 5%. We are getting some headlines out of that earnings call. NextEra will partner with GE Vernova to build natural gas-powered generation. The company also asking U.S. regulators for a licensing change to restart its nuclear plant amid soaring demand for AI and data centers. As we mentioned, shares popping on at least this combination, it seems like, and hopefully some relicensing. Yeah, I've really been digging into the utilities over the past year because of the whole AI trade and the demand for power. NextEra, just by way of a little background, it owns Florida Power and Light, which is the biggest utility in that state, and then it also owns a renewable power generation business, so wind and solar mostly, and presumably the nuclear plant would fall under that if it does indeed get the go-ahead to reopen it. That plant, by the way, is called Duane Arnold. It's in Iowa near Cedar Rapids, and it was the only operating nuclear plant in that state. So now the company is saying it has asked U.S. regulators to reopen it. That's sort of the first step, and then there would need to be more regulatory steps, and it could potentially be very expensive, analysts have said, but is aiming to get it potentially potentially back online as early as 2028. Anything like with the whiff of nuclear these days, you've seen a lift. Constellation Energy, one of the other big utility companies, of course, is working on restarting 3 Mile Island. That stock has soared over the past year. NextEra hasn't done quite as well as its utility competitors. It's up about 25% over the past year. But it seems to me that this news and this confirmation, it was something they had talked about, potentially overwhelming the disappointing numbers on the earnings side.
It's interesting to track at the same time, too, as tech companies, the likes of Oracle, are even talking about their investments in nuclear and primarily on their side, nuclear reaction energy, in order to build out even more of the necessary kind of inputs to powering the future of the data centers for artificial intelligence.
Yeah, and what has really changed with the nuclear cost calculation is that before, there was nobody to pay for these things. In other words, nuclear power plants are extremely expensive, especially to build and bring online, in part because of all the regulation that's around it, as there should be, right? Because it's something that is potentially dangerous. But 3 Mile Island, what makes the difference there is that you have in Microsoft a dedicated customer. So the thinking is if NextEra or any nuclear project in the US can get that sort of dedicated AI customer, then it starts to make more financial sense again.
I hope everybody took notes. Julie, thanks so much. Appreciate it.
Of course.
President Trump is dismantling diversity, equity, and inclusion programs as a priority in his new administration. DEI, as you know them, diversity, equity, and inclusion initiatives seek to correct long-standing discrimination experienced by people of color and LGBTQ+ workers in the workplace. That discrimination, according to Citigroup, cost the U.S. economy $16 trillion between 2000 and 2020 alone. But President Trump and other critics say that those opportunities come at a cost to others and have made it a priority to reverse many of the initiatives that the federal government put into place under former President Biden. Among some of the DEI initiatives reversed in Trump's first few days, racial bias training at work, diversity, equity, and inclusion offices and programs, and a 1965 executive order establishing non-discriminatory hiring practices for federal contractors. For now, most of the efforts are focused on government offices, but some businesses are publicly standing by their own diversity initiatives and values. When discussing the matter with Yahoo Finance at the World Economic Forum in Davos, Switzerland, Nasdaq CEO Adena Friedman had this to say.
I can say for Nasdaq, we're very proud of what we do. We're very comfortable and confident in what we do. We feel very good about the results that we've been able to achieve in terms of creating that culture of inclusivity and belonging. And I think a lot of companies feel the same way I do. And it's just going to be a little bit quieter in how they implement.
JP Morgan CEO Jamie Dimon also reaffirmed his commitment to diversity and inclusion while at Davos in the face of shareholder activist attempts to disband its programs. And it's not only executives who are pushing back. Costco shareholders voted to block an anti-DEI proposal from a conservative firm, the National Center for Public Policy Research. 98% of shareholders who voted chose to defend existing diversity policies. The next major test of defending diversity, equity, and inclusion in corporate values comes in the form of a similar shareholder vote on February 25th at Apple, even after CEO Tim Cook was seen attending the inauguration of President Trump alongside other tech CEOs. Pushes for equity and inclusion may not be as vocal as before, as you heard from Nasdaq CEO Adena Friedman, but for the Trump-proclaimed golden age of America to become a reality for all American citizens from all walks of life, based on the aforementioned data, it would also benefit the economy at large to not revert to practices that exacerbate income inequality and opportunity. Well, in just his first week in office, President Trump has set about rolling back legislation passed by the Biden administration, including an executive order that would make more drugs available to Medicare patients for just $2. Joining us now with more, we've got Yahoo Finance's Jordan Weissman. Jordan, what do we know here, and how is this rule supposed to work?
Yeah, so this is a small but I think really telling story from the first week of the Trump administration. Essentially, he rolled back an executive order that Biden signed in 2022 that just told federal regulators to find more ways to reduce the prices of prescription drugs. They had already passed, as part of the Inflation Reduction Act, the big Medicare prescription drug price negotiation program. And this is to find other ways that they could make pharmaceuticals a little bit more affordable for seniors. One of the ideas that they came up with, that the regulators came up with, was this thing called a $2 drug list. You see companies like Walmart do this, where they say, hey, here are all the drugs we offer for $4 a pop, for $2 a pop. The idea was to have Medicare prescription drug plans do something similar. Say, here are all the generic prescriptions that are commonly used that you can get for $2. And the idea was, this was going to save seniors a little bit of money, possibly, maybe like $50 a year, but it would put a little bit of extra cash in their pockets, about $2 billion for everyone collectively. That program that was never implemented, but it looks like it's going to be scrapped as a result of this rescission of the executive order.
Now, Trump has said as recently as yesterday that he wants to lower costs for Americans. Why would he want to get rid of this rule?
There are some ideological differences between Democrats and Republicans when it comes to dealing with prescription drugs and how to manage Medicare. A lot of conservatives saw this program as kind of micromanaging the prescription drug program. And that's part of what's probably going on here. There's also just a desire to, I think, break with the prior administration. But people are wondering what this means about how Trump is going to handle those upcoming Medicare drug negotiations. This year, the Trump administration is going to be in charge of negotiating the price of 15 pharmaceuticals, including Ozempic, for Medicare. How is he going to handle them? Is he going to drive a hard bargain? Not clear. People are a little curious after rescinding this executive order on drug prices.
Jordan, thanks so much for tracking this and bringing us to the latest. Appreciate it.
Thanks for having me.
Certainly. Coming up, everyone, we're talking housing, from the latest data on existing home sales to advice for securing a lower mortgage rate. All that coming up.
quarter, first half of the year. So we see a lot of folks sitting on the sidelines trying to pick the perfect moment to enter the market. I don't think a perfect moment is going to present itself anytime soon.
So you actually lay out some potential solutions for the housing market. Break them down for us.
Yeah, Brad, we had a lot of fun last night. We did the squad and I did a full brainstorm for your show to say, if we were buying right now, what would a squad of insiders do? So a few very fast tips. First, the CFPB mandates we do something called a loan estimate as a mortgage lender, and it is a uniform way for customers to shop rate and hidden fees. That's where we see many customers get nicked on affordability, is they don't get a comparable rate. They see a marketing rate online. So that would be number one. Get a CFPB loan estimate. It's what it says on the top of it. Number two, play the address game, as we call it. There are a lot of incentives for lenders like ourselves, banks, to lend to folks that have up to an 80% of the average median income, the AMI. Sometimes we can earn thousands of dollars more as a lender when someone's below that 80% AMI threshold. Some lenders pocket those thousands of dollars. Tomo, in our case, pass it back in the form of lower rates. There's a tool that is a wonderful tool on Fannie Mae's website called the AMI tool, where you could check your area median income versus your average. That can save you thousands of dollars.
What?
Hey, yeah, go ahead.
Yeah, no. Please continue, and then I'll jump in.
Yeah, we've got two more quick ones. DTI and credit thresholds. Hey, we always recommend you work with a loan officer who's experienced and savvy and understands sometimes a little threshold, a 5 or 10 point improvement in your credit score can actually put you in a different risk bucket, and you'll see a rate that could save you hundreds of dollars. You want to work with a loan officer or online tools that are very savvy about, hey, maybe a few $100 payoff on a credit card line will save you thousands of dollars over a year.
What type
Those
of...
would be the big three.
Certainly. And so what type of changes are you anticipating to come from the current administration to fix some of these issues, inventory and high rates?
Yeah, hey, there's some things in control politically, and there are some things that we just can't touch. The key driving factor are two in housing affordability. It's the mortgage rate, which is going to be driven by inflation, and I know you've talked a lot about that on the show, and we know how linked that is to employment and some of the political decisions being made in DC. So it's really affordability is about rate and it's about insurance. We haven't talked about this together, but household insurance numbers are just up through the roof. Nationally, we're seeing in our customer book a minimum of a 15% increase. If you're not a climate impacted area, we're seeing 50 and 60% home insurance rate increases in climate impacted area if folks can get insurance. That's my primary worry right now about affordability is insurance, particularly climate impacted insurance. And then, hey, what can the administration do? They got to keep a wary eye on inflation. They got to take a hard look on home insurance policies with what they can impact federally, I guess. And then we got to build, baby. We got to build. There's no way out of this situation. There are more people that want to start building wealth by getting in a home than there is supply.
And so with that in mind, it seems like on the labor force participation side, it would also behoove us to still have the same amount of inputs in terms of employees helping to build out more homes as well. And if we're, in order to see the necessary kind of gap be rectified for building out homes, what type of rate do we even need to be producing homes at in order to meet the demand and also bring down prices at the same time?
Yeah, hey, we think we're 7-8 million homes underbuilt in the United States today. We tend to produce, depending on the year and what's going on, between 500 and 1 million new homes a year. So we've got years and years and years of backlog, and that's without climate disruption like we saw in California. So we need significant creative action to make any real progress on inventory numbers.
Yeah, certainly. Greg, we're going to be tracking this. We know you will be too. Greg Schwartz, thanks so much for taking the time.
Yeah, thanks for having me.
Certainly. Coming up, tax season right around the corner. We've got some tips to help you start preparing right now. That's next on Wealth. It is just that special, but also sometimes stressful. Tax time. Well, it officially kicks off January 27th. The IRS is expecting more than 140 million individual tax returns between now and April 15th. Mark Stieber, who is the Jackson Hewitt Tax Service Chief Tax Information Officer, joins us now on set with what you need to do to prepare your own filing. Great to have you here in studio.
Good to be here. Very important.
All right, a big, wonderful time of the year for you at Jackson Hewitt. You sent us some of the categories that folks can use to get themselves organized before filing. So break those down for us.
Well, I'll say this. Don't get overly complicated with it. Keep it simple, something that you're able to do. It's kind of like exercising. Don't get a big plan. Get a plan that you can obviously do. I like the envelope or the shoebox because documents are coming in January 31st. W-2s, 1099s, 1099K, crypto activity. Find a place to store that. And if you've got a significant other, make sure y'all are aligned and there's not two sets of documents. Second, find last year's stuff. It's a great trail or roadmap for what to watch for. For the third piece, your life changes during the year. So take your current documents, your last year return, reflect on your year. Did you get married, divorced, you had a side hustle startup? Those three pieces of information are critical to getting your taxes done.
Now, you don't have to file early, but it seems like there are some benefits to just getting it done, getting out of the way. What are some of those benefits?
Well, more importantly now than in the last 117 years that we've had a graduated tax scale. First reason is 100 million people get a refund. About $3,000 last year, probably that this year. So 2 out of 3 get a refund. File early, get your money early. You don't have to be a financial savant on your show to go, well, yeah, if you're rating on 3,000, get that now. So file early. Second reason, more important than the first, a lot of bad people creep into the system when there's that much money. So there's scammers, there's data thieves, there's people buying stuff on the dark web, filing fake tax returns to steal your tax refund. But if you file early, or as early as you can, your information is locked up with the IRS. They lock up your social security number, your personal information, significant others, your kids if you got it. So that scammer that comes in after you, they get denied. The third reason is, and I hear this a lot, I'm just gonna wait till I have the money in April. I got 81 days and about 11 and a half hours. I'm just gonna wait. Well, the reality is if you file early, even if you owe or think you're gonna owe, 2 things happen. One, you know the exact amount of money, so you can put that aside. And secondly, you still don't have to pay till April 15th. You file now, enjoy the benefits of locking up your data. Imagine you can just debit that bank account, write a check, or put it on your credit card in April, set it up now. So file early, get your money. File early, lock up your data, and file early even if you think you're going to owe or know you're going to owe, and you still don't have to pay.
I mean, there aren't as many large-scale tax changes as there were in the past, we know, but there is one tax form that many self-employed folks out there may be receiving this year. Break that down for us. What can you tell us about the 1099K document?
Yeah, that's our number one question item right now, and it is a pretty big deal. And as you say, it's been around for a while, but there's a big change for tax year 2024 and a bigger one for this year and even a bigger one for next year. A 1099K is issued by a third-party payment platform. Think Venmo, Apple Pay, any of those things where you're electronically sending money. Used to be you had to do that 200 times for business and have $20,000 of net activity for the year. Now the number's $600, but there's a 3-year transition, so it's $5,000 for tax year 24. So if you got paid $5,000 or more, even in just one transaction, you'll get a 1099K. But so will the IRS. So there's no more, that's a side gig or a hobby or whatever your misunderstanding might be. The IRS will now know you got electronic monies. That has to go on your tax return. And as I say, the ultimate number is $600, but they gave us a 3-year transition. So that's in place right now, $5,000, one transaction, you're getting a 1099K. So if you sold those Taylor Swift tickets, that could be on there.
If you made that much on your Taylor Swift tickets, then kudos
well,
to
be
you.
clear, it's not made that much, grossed that much. And if you put that on there, that's not the correct amount either. So it's a complicated topic and a big change this year.
Good clarification. We do know as well that the IRS has announced tax relief for individuals in California impacted by the wildfires. What should taxpayers keep in mind with relief programs like this? Is there anything that they need to file or be mindful of?
Yeah, be mindful of get your house and your life in order first. Tax is clearly a secondary consideration. But it's important once you're stable and your life and family are safe, there's some great tax loopholes in the tax law related to disasters of this magnitude. They include an extension of time, and I saw that LA County and several others have already extended the tax season all the way out to October, and that's a double-edged sword. Just because they did extend it don't mean you should wait, because there's several other great benefits in there if you have a federal disaster disaster area. There are ways to immediately file a loss claim on a prior year return and recover prior year taxes. There's other options that you can make if you've had a loss and how to calculate the loss. So once you get your life settled, do talk with a tax pro about the tax benefits of a federally disaster, tax deduction that might be available to you. And then watch out for scams. There's a lot of scams out there that say, give me a credit card and I'll get you some federal disaster credits. There's no such thing. But there are tax deductions, tax extensions, tax delays on liabilities, payroll, income tax, and the rest that really will help you out if you're concerned about your taxes. The most important one I would leave you with in your audience, there are some great tax deductions that you can go back and get your prior paid income taxes with a fast application if you've had a real bad disaster deductible loss, which is really an out-of-pocket, uninsured loss.
Certainly. Mark, thanks so much for the tips, taking the time here with us. Appreciate it.
Very exciting.
Coming up, everyone, whip out that wallet and swipe. Stay tuned for my conversation with the Senior Editorial Director of The Points Guy. We'll talk credit card trends, points, and get some tips if you're looking to open up a new card. Stay tuned. Credit card balances and delinquencies are rising according to fresh data from the Philadelphia Fed. Revolving card balances, or the portion that carries over month to month if you don't pay your balance in full, accruing interest rates all the while, hit $645 billion in the third quarter of 2024. That is up more than 50% since a decade low back in the second quarter of 2021. The data also revealing the share of active credit card accounts making the minimum payment is at a 12-year high. And household debt is at an all-time high of $17.9 trillion, according to the New York Fed. So what does this say about the state of the consumer? Here with more, we've got Nick Ewan, who is the Senior Editorial Director for The Points Guy. Nick, good to have you here with us. So what does this data say about the consumer from your read-in right now?
Yeah, I think it says that a lot of consumers are really relying on credit cards to make ends meet. You have prices that are still rising, albeit not as quickly as they were a couple of years ago, but the incomes are not keeping up with that. We've seen prices of eggs skyrocket and other kind of household staples. So a lot of consumers are digging into their wallets to use their plastic. And unfortunately, this really has knock-on effects because that interest accrues at very high rates. Most credit cards have variable APRs. They are coming down slightly as the Fed lowers interest rates, but they still can be 20, 25, almost 30%. And that really adds up over time. So it becomes a really vicious cycle if you're just making those minimum payments and not paying your balances in full and on time.
What credit card trends are you anticipating for 2025?
Well, I think there are a couple of big ones that we've seen. A lot of credit card issuers are wanting to get more wallet share, so more spending from their customers. So they've launched a lot of partnerships, some additional incentives for card members to use their cards. One of the other big things we've seen is a shift towards rewarding those high spenders. So if you're a small business owner and you're spending $200,000, $300,000, $500,000 a year, there are a lot of really great ways that you can leverage credit cards, not just to earn rewards, whether it's cash back or travel points or airline miles, but actually earn elite status with some of these programs. Of course, we love our elite status here at The Points Guy, but you can actually, in many cases, spend your way to status with an airline or with a hotel program without ever doing business directly with that airline. So it's a really fascinating trend. It's one that's been picking up over the last several years, and I think it will continue to accelerate moving forward.
We're also getting earnings from the big airlines, and we're seeing them bullish on travel demand in the year ahead. A lot of airline rewards cards have some good perks. So what are the best travel cards that you're seeing right now from your evaluation?
Well, it's really interesting because that trend of rewarding big spenders, a lot of the more casual travelers who maybe take a few trips a year, a little long weekend getaway and maybe a 1-week vacation here or there, a lot of them are potentially skewing away from some of these cards that are affiliated directly with an airline or a loyalty program. A lot of them like the more flexible rewards cards. So a couple of the really popular ones that we recommend here at The Points Guy are the Sapphire Preferred as well as the Capital One Venture Card. Really nice thing is those offer a lot of flexibility. You're not locked into one particular airline or one particular hotel chain, but you really need to ask yourself, what are the rewards that you're looking for? How do you spend your money? Where do you live can actually be a really important factor in picking the right credit card. Because if you're in an airline hub, for example, maybe an airline credit card with that particular carrier is going to get you perks like free checked bags, priority boarding, and unlock other benefits. So it's really important that you sit down and kind of look at your own situation and identify if you would benefit from one of those specific cards or if you want that more general purpose card. And a lot of people are really opting for that flexible reward system.
What is the checklist that people should be running through if they are opening a credit card this year?
Number one, most important thing, as we talked about before, with the increasing share of consumers just making those minimum payments, a new credit card is not an excuse to spend beyond your means. No matter how lucrative those rewards are, any interest, any late payments for not paying that bill on time is going to eat into the value of those points. So if you're going to open a card, do not spend beyond your means. I also want to stress a lot of people are really turned off by those annual fees that come with credit cards. Some of them are manageable, $95, $99, but they can go up to almost $700 a year. Crunch the numbers and make sure before you pay an annual fee that you're going to get that amount out of it. And the final thing to consider, especially if you have children, teenagers, consider adding them as authorized users to a card. That can help teach them financial responsibility, but can also give them some credit history so that when they go off into the workforce on their own, they're not starting from scratch. They've already built up a little bit of a credit history. You can make it easier to get approved to rent an apartment, get approved for their own credit card, and can set them up for some financial success in the future.
Nick, thanks so much. Really appreciate it, and a solid outlook for what we could see within the space in 2025. Appreciate it.
Yep, thanks for having me.
Certainly. Let's get a check of the markets here as we're taking a look right now at the S&P 500, and we've got this on the max view that we could give you. Let me give you an intraday though, just to see where you can ultimately get a sense of how the candlesticks and how the trend lines are knocking around here right now. As of this point, we are flat just barely to the upside here, but taking a look specifically at the ranges that we've been tracking here on the day and the day's range that we've also been taking a look at here, we're continuing to watch and be on watch for even more potential all-time highs here. You saw some of the candlesticks a moment ago. I'll just give you another gander at what exactly we were tracking earlier on in today's session. You had a pop out of the gate within the first 30 minutes of trade here. We're still holding on to fractional gains, flat to the upside as it may be. The Nasdaq Composite flat to the upside as well as of right now. For the tech-heavy average, 0.05% in the green. And then the Dow Jones Industrial Average, you're seeing that just barely to the downside right now by about 0.1%. Also want to take a brief look at some of the sector activity. Let's light that up for you here on the day. 11 sectors in the S&P 500. Utilities is leading the pack right now. And then you've got energy actually pulling up the caboose. That's down right now, despite starting off the day in positive territory, lower by about 0.5%. And I mentioned technology a moment ago. Let's just take a quick look at the Nasdaq 100 here. You see we're pretty mixed. It seems like there are more positive and gainers than we are seeing laggards here right now. But one of the largest laggards that we have on the day, Texas Instruments. I'll just put this back on the market cap weighted view here. Meta, for all you folks out there that are tracking shares of META, call it a new all-time high day intraday that we're tracking for Meta platforms. That's up 3% right now. Coming up, are you considering mixing your money with your boo? Our next guest has a 3-step process to make sure that you get through the process without a breakup. That's next on Wealth. President Trump is speaking live in Asheville, North Carolina, taking questions about how his administration will address disaster damage. Let's listen in.
About what?
Have you decided how much money you would allocate for disaster relief?
I haven't. I have to see what it is.
Are you disappointed that Senator Schiff hasn't joined you on this trip? It's reported that you invited Senator Schiff to join you on this trip and he was too busy. Are you disappointed?
I don't know. I was told that Schiff was going to travel with us to California. I wasn't thrilled, to be honest with you. And I saw him last night on television. It looks like he got hit with a baseball bat or something. What happened to him? Something happened to him. It looked like he got hit. It looked like he got beat around. But I'll ask Caroline to find out what happened to him. No, if he wanted to come out, I would have done that. But I don't know. Somebody said that he wanted to come on the plane, but I think he's staying back for the votes. There's some pretty good votes going on. Yeah.
Mr. President, what is your timeline for getting rid of FEMA?
For this one? For this one?
You just talked about possibly getting rid of FEMA. What timeline are you looking at, and how would you do that?
Well, we're looking here. Here you're talking about. To start, we're going to start immediately, timeline. And to finish, it's going to be a period of time. You know, people are also rebuilding their houses. How long does it take to build a house, right? It takes some time. And I want them to build houses bigger, better, nicer than they had before, so they can have, at least they get something out of this disaster. This was a real disaster. No, timeline will be fast. In terms of infrastructure, I think very fast. I want to thank Elon, because Elon was able to get us communication systems, as you know, Starlink. We had no communication. The first day I got here, I was asked by one of the people, one of the really great representatives, professionals, that is there any way you could get Starlink here, because they had no communication whatsoever. And I called up Elon Musk, and he had, hundreds of units brought here, brought immediately. And it's hard to get. They couldn't get them before. And that made a lot of difference. I think it saved a lot of lives, actually. Yeah. Infrastructure-wise, we'll do it quickly.
Sir, can you just talk about how long?
Okay, you were listening into comments from President Trump in Asheville, North Carolina, and discussing the possibility of getting rid of FEMA and saying it was going to take some time to evaluate. We'll continue to monitor any developments there. Switching gears here, survey says joint banking may be a good sign to a relationship and a good key to a relationship. MarketWatch found 60% of survey respondents who used only joint bank accounts said that they were very satisfied with their relationships, and that couples who use joint bank accounts argue less about money. The stat, 2% of joint bank only respondents report arguing 3 or more times a week versus nearly 11% of those who use personal accounts only. We're going to dig into this with Emily Luck, who is the co-founder and CEO of Plenty, who is a free budgeting app for couples to help manage their money. Let's start with the base case here. What is your general advice for couples merging finances?
I think no two couples are ever the same, but a really important place to start is actually, before you even talk about how you want to merge money, really focusing first on what was it like growing up? What did our parents talk about? Was money a normal conversation that we had? Was saving and investing a normal conversation? I think it all starts from there, but that foundation is really important to make it easier to understand your partner, or else it makes all the other conversations so much more complicated and more likely for you to fight.
You have a 3-step process for merging accounts and finances. Can you lay that out for us?
Yeah, so I think the 3-step process, we actually built the entire product at Plenty around this process, and it came out of personal experience that my husband and I went through. The first one is saying you need to understand and define what's mine and what's ours. So I think for that part of the process, for many couples, it evolves over time. And so what we're increasingly seeing for people who are getting married is that they're not fully merging everything from day one, and that's okay. So I think that's the first thing you define. The second part is you start to really think about, okay, how do we think about where our money is going? How much do we want to put aside for spending? How much do we want to put aside for saving and investing? Then the final piece of it is really trying to understand what is going to be coming up in the future. So what are things that we are going to be saving for? What are our shared goals there? And how much do we want to be saving each month in order to save up for those things coming up in the future?
What are some other considerations when you're looking to merge your money together?
Mm-hmm. Well, I think our generation, one thing that's really important, we hear this from couples all the time, is that things are really different from our parents' generation. So if you look at the baby boomer generation, the majority of couples had a single income dynamic. And by nature of being single income, the default was that everything was fully joint. And I think that's really different today when you look at the millennial generation, where more than 80% of couples both work. So there's baked in independence, and they both earn income that way. That's actually why I think there has been given a rise where even if you do see everything as ours together, you practically have credit cards under one person's name, you have retirement accounts under one person's name, and that's just a normal way of how money works. And so I think for that, what is really important there to understand is just to make sure that you constantly talk about money and have shared visibility and transparency.
Just lastly, while we have you here, I would love to know, for Plenty, how is the business doing? How are you helping couples really reach some of these goals? And, what are your own goals for Plenty in continuing to scale the business?
Yeah, so right now we've had an incredible start to the year. We've actually grown the number of couples on our platform by 3x over the last month alone. Definitely feels like a great time because it's a new year, it's a fresh start. I think a lot of couples are coming into 2025 really thinking, how can I manage my money better in 2025? So with our product right now, we help you answer 3 really critical questions. First one being, where are we today? How much money do we have together? How much money do I have on my own? The second question we then help you answer is, where's my money going? Where's our money going? What are we spending on? How much did we spend on eating healthy last month? And the third piece is we actually help you with saving and investing for your shared goals. So we'll actually help make recommendations of what you should invest in, how much money you should put aside, as long as you come to us with saying, hey, these are the important things that we have coming up in the next 1, 2, 3, 5 years, and we'll help you manage all of that.
Emily, thanks so much for taking the time here with us. Really appreciate it.
Perfect. Thank you for having me.
Certainly. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Josh Lipton and Julie Hyman coming up 3 p.m. Eastern Time. You don't want to miss it.